एक मिनट। YouTube पे आ गया है। उस पे कैसे पार्टिसिपेंट्स को दिख रहा है कि नहीं, ये कैसे समझेगा? हम्म। हाँ, फटाफट चेक करो, 15 मिनट में शुरू करना है। अच्छा, जो दो लिस्ट भेजे थे दोनों को कर दिया ना आपने कॉन्फ़िगर? उस पे कैसे पार्टिसिपेंट्स को दिख रहा है कि नहीं? हाँ आपने। Hey, Access team, just put off your video. Hey, Access team, can you hear me?
Is the frame okay? We just wanted to test the frame. We'll put off the video.
Yeah, frame is fine. Frame is fine.
Okay, cool. Thanks. Team, we'll get Ashwini any minute. Let us know when we have to start.
We will start in another 10 minutes max.
10 minutes.
Yeah, so
Okay.
ask him to be here by 3. Sorry, 4.
He's already here.
Yeah.
He's already here. So,
Hi, I just came.
we'll get Ashwini any minute. Let us know when we have to start.
We'll start in another 10 minutes max.
Hi, can you all hear us?
You can also check the video, no? The thing.
Hello, we are in the room.
Hey, hi.
Hi, can you hear us?
We can hear you.
Okay.
I just want to check, is the can you hear the sound repeating? I mean, the whatever we are speaking. Yeah. Just give us 5 minutes, 2 minutes.
Sure.
Yeah. Well, Ashwin, now, I mean, let's just do a test run for some time, because there was I could hear double voice, whatever we were speaking.
Same here, and we got a little confused because we were wondering what was happening.
No, nothing. I think they were just setting up, and there were 2 accounts open on my laptop. I don't think it should happen now. I can't. So just wait for.
I'm not hearing this. This conversation is not coming looping, so hopefully it's fine.
Yeah. I think. So let's just wait for 5 minutes and then we get started. Yeah.
Sure. And we'll just while we wait, in terms of the way we discussed it, so we'll keep it like that. So you kick it off and sort of set the context.
So this is live right now. So basically, audience is joining in through a virtual event platform.
Okay.
And we are on Zoom, but we are live. So yes, I'll quickly get the thing started, and then I'll hand it over to you, and we can. So we have around 30 minutes for your talk, and then we move on to the panel. So just give me a few minutes, we'll get started. Yeah.
Sure.
So Ashwin, can we get started? Yeah, all set.
Yeah.
Super. So great. So I think we're just bang on time. So audience, without further ado, let me extend a warm welcome to all of you to our inaugural Investment Products Innovation Showcase. A concept which just came up over our conversations with multiple people in the industry and among the investors about the sheer variety of investment products that are right now out there in the market. Indian investors are increasingly becoming experimental with new investment products and platforms, and the wealth advisors it's only adding to the more confusion for wealth advisors, because for this, for them to differentiate between the right product and the wrong product to advise is becoming all the more confusing, especially when it comes to new age investment products like cryptos or NFTs, etc. So we thought, is there a case for setting up an annual platform where we can bring the most innovative and exciting new investment products on one platform, and this could be of help both to investors who are looking to for new opportunities to diversify their investments, as well as wealth advisors who are looking to add new products to their offering. So on the basis of our discussion with some of the industry leaders whom you will see over the next few days, we conceptualized this entire initiative called Investment Products Innovation Showcase. And the idea in this towards the next 10 days will be to bring in thought leaders and industry leaders across 10 different asset classes who we believe are doing some very, very exciting work and could rewrite the rules of the game going forward. And that's only good news for the investors, because they will not only have the quality in terms of variety, but also will have not only quantity in terms of variety, but also will have a lot of quality to back it in terms of research and strategies. So today we are kickstarting this inaugural IPI with the AIF and PMS segment, and I can't thank our speakers and all our partners for this segment enough to agree to put in their time and efforts. Special thanks to Axis Asset Management to back this idea and to join us as a co-organizer for this segment. So thank you, Ashwin, Vikram, Khushbu, Lakshmi, and all the team members who've been slogging out with us over the last few months to put this up together. But I'm sure the agenda has come out really well, and the audience today is really, really going to benefit out of this. Of course, audience, the speakers are will be more than happy to connect with you even after the event. So do feel free to reach out to them. The distributors out here, all the speakers today are going to add a lot of new dimensions and products to your knowledge portfolio. Please do feel free to reach out to them and their teams after the event is over. Let me also tell you on behalf of Equalify, this is just the start. We are still doing this online because the sheer breadth and depth of this particular event needed an online platform. But we want to do a lot of offshoot, smaller gatherings and meetups and masterclasses in an offline format like we used to do earlier. And hopefully that will get started with from the next month onwards. So a lot of exciting learning times ahead. For that, I will invite our first speaker and our first partner for this entire initiative, Mr. Ashwin Patni. So Ashwin, welcome to IPI and welcome to, I believe, your first Equalify event. So glad to have you and Axis on board with us. And before I hand over the mic to you, audience, let me quickly share a quick introduction of Ashwin. So Ashwin is heading products and alternatives at Axis Asset Management. He joined Axis AMC in 2010 as a portfolio manager for PMS, and he was later elevated to the post of head of products. Prior to his engagement with Axis AMC, he was with IDFC Asset Management Company as a portfolio manager. He began his career with Accenture in 2001 and also has worked with ICICI Bank as a manager for the Structured Products Group. By qualification, he is a postgraduate from IIM Calcutta and a BE in metallurgy from CFA USA. So the moment you add a IIM to someone's name, I'm sure the audience only gets more and more excited to listen to that person. And if that IIM also gets going along with an investment as a subject knowledge, so I believe this is we can't ask for any better start than that. Ashwin, thank you so much for agreeing to be a part of this entire initiative. I'm handing it over to you too, and we're all eager to learn from you about what's keeping you excited about the AIF and PMS sector. What do you think the situation is going to pan out for the next year or so? And what are the more innovative and exciting things that are keeping you awake at night? On that note, handing over to you, and welcome on board again.
Thank you, and thank you to the entire team. In fact, at Equalify, I think what you guys are trying to do is something that we really think is a fantastic initiative, and that's why we were so keen to partner with this. And I'll talk about my views and how I see the entire PMS AIF, or what we call the alternative industry, evolving. But first and foremost, for any sort of new industry to take shape, is that you need a lot of people with the required skill set, with the required understanding. And I think that that's why it's so wonderful that we have forums like these, which allow a large number of people to participate and sort of share ideas, understanding, etc. See what's going on, and really wonderful initiative. With that, let me kickstart my thoughts. What I'll do in sort of the 20-25 odd minutes that I have got is lay out a context in terms of what I believe we are seeing in terms of the growth and the evolution of the AIF PMS industry, and I'll try and see it from a few different dimensions. What are the key drivers that are enabling it? What are some of the developments that we are seeing as we, especially in the more recent years, which are really giving it a big leg up. But to kickstart this, just in terms of the context, I think one of the big successes in the last 20-25 years we've seen is just the way the mutual fund industry has grown and become more and more relevant in the financial savings pie of the general population in India. I'm sure you all know the big numbers, but the staggering thing is that the industry, which is give or take somewhere in the region of about 36 lakh crores today, if you go back 10 years, was maybe 1/5 that size, closer to 7 odd lakh crores back then. And we've seen the industry grow at almost close to 15 to 20% kind of compounded annual growth rates over this period. I believe a lot of that growth was set in stage because of the good work that mutual funds did in the first decade of this century, which is basically 2000-2010, where a lot of the performance, the products, the skill set was put in place, which gave investors the comfort and the confidence to start allocating material money and to benefit from this. And as it became a sort of a virtuous cycle where good products, good performance, good experience of investors allowed more and more investors and newer investors to get drawn in, and that's what's worked for that industry. The coincidence is that if you look back, if you draw that parallel with what we call the alternatives industry, the AIF PMS, we are at about, and if I draw the sort of somewhere the birth of this alternative industry, and I know in some form or shape it's been around for a very long time, but I think really the fillip got going with the AIF regulations, which SEBI put in place roughly about 10 years ago. So from an industry perspective, I think we have now spent a decade sort of just putting together the platforms, what this stands for, getting the first phase of the platform really in place. And coincidentally, we are at a size where the mutual fund industry was about 10 years ago, while in terms of if you add the AIF PMS numbers, we're roughly give or take in the region of about 7.5 lakh crores in AUM. Of course, our growth rates are much higher given that we're starting off a smaller base. So this industry is now growing at more like a 25-30% growth rate. Mutual fund is a much bigger industry, growing at 15 to 20. But I think the power of this idea is now very well established, and it's really now very much ready to really go for the next leg of growth over the next 10 years. And which is why I think, and I mentioned this in my run-up and my remarks to this event, that the excitement that I feel in terms of the point in time that we are right now in the alternatives industries, I think that this is the most important development, or the most important thing that has happened in any investment industry in India in the last 20 years. Because if you go back to mutual funds 20 years ago and this one today, that's really the power that this can bring in terms of the change that it can bring to the landscape of investments in India for investors. Why are we so confident? Like I said, there are a number of different dimensions that are driving this, and let me take some of them one by one. The first and foremost, I think what we are seeing, and many, by the way, of these trends are not limited to India. We are seeing these trends play globally, and India is also joining that. So one of the big trends is that there is a little bit of a barbell that we are seeing in terms of the investors' attitude towards risk, towards complexity, towards sophistication, and they are actually approaching this at increasingly in two different extremes. On the one hand, we are seeing increasing favor and bias for very simple, very liquid products, and what we have seen is the boom in the passive space, index funds and ETFs as one extreme outcome of that. Very simple, easy to understand, easy to execute strategies, highly liquid, give people the power to really be on top of that in a very simple and easy way. But on the other hand of the spectrum, we are seeing demand for highly sophisticated, highly complex, different risk payoffs which investors want. So there is this dichotomy which is happening, and as I said, this is not unique to India. This is happening at a global level, where investors want and increasingly are gravitating towards these two extremes, where part of the portfolio is very simple and easy and straightforward, like passives, and a part of the portfolio is into very complex and more sophisticated strategies, represented by, broadly speaking, the alternative industry. Why is this happening? The need for this is essentially the need for, at a portfolio level, people have understood the need for diversification, the need for having different asset classes and lack of correlation between different asset classes to come in. And increasingly, the simplicity allows you to capture the beta of the market, whether it's the debt markets or the equity markets, in a very simple, cost-efficient, transparent manner. But there is also other risk profiles and other return profiles to be made, which the sophisticated strategies allow you to capture. So can you invest into hard assets? Can you invest into different payoff profiles? Can you invest into different risk management approaches? And that's what alternatives allow you to do. In many ways, this is also represented by what the regulatory environment is doing, where what we have seen is increasingly the mutual funds getting more and more straitjacketed in terms of their profiles, in terms of what their investment objectives are, in terms of what their strategies can be, so that the investors are getting more and more sort of are able to enjoy investing in them in a very simple and easy and transparent manner. And on the other hand, what is represented by, let's say, the AIF regulations, which allow you to try for the sophisticated sectors. So that's the first context, which is the investor context, which is that there is a need for these two extremes, and people understand intuitively what they bring to the table. This is also, I think, coming out of the better understanding and informed nature of the investor community itself that we have seen. I think, again, I will draw this parallel with the growth in the mutual fund industry, where we have seen a huge jump in number of investors and their participation. And somewhere that awareness, education, understanding is now flowing through in the form of people being able to better appreciate some of these newer opportunities. It's also in the last 2, 3, 4 years, I would say it's also really a great context from a regulatory environment where a number of different things are now also in place for the next leg. I mentioned that the first leg of the alternatives, I think the trigger was the AIF regulations, which really put in place the context framework for offering some of these strategies. And I think last 2, 3 years, we've seen some really significant new ideas that have come in here. And if I were to name 2 or 3, I think we've seen a dramatic overhaul of the PMS regulations. We have seen provisions for accredited investors. We've seen provisions around how co-investors, co-investments can be made. Slightly on a different note, but we've also seen the emergence of Gift City and structuring options for global investors coming in as well. So there is a bunch of exciting developments that are taking place in terms of the regulatory architecture, and also I suspect reflecting the maturity of the AIF as a platform that we are able to take advantage of as an industry. The other thing that we are seeing also is the broadening of the players. When you say players, you can see it from both sides. One is from the manufacturing or the investment side, and the other one is from the investor or the investor community side. Let me take the manufacturing side first. Historically, alternative investments were done much more out of the big global investors and who used to raise global pools of capital and invest into India. We've seen the big famous private equity funds, the big famous real estate funds, and the examples are there, hedge funds, etc. Big global giants who used to also invest into India. What is changing now is the emergence of very, very strong domestic players, which are both in some cases boutique managers, which are run by the investors themselves, and that's a very healthy profile because these boutiques are typically founded by the key fund managers or investors who understand what they're getting into, and they want really those the firms to reflect that. And on the other extreme, by large financial platforms such as, for example, us here at Access, but a number of other domestic platforms are also come up where they are able to solve for using a much better understanding of the domestic market, what is the right set of invest offerings, as well as how to engage with the investors in the right way. So there is a big diversification happening, like I said, in terms of the investment manager or the manufacturing end, where from a more global led, we are seeing a more domestic led, within domestic boutiques and large domestic platforms. On the investor side, again, we are seeing much more broadening. We are seeing a situation where we are going from, again, more driven by dominated by global institutional investor base to, again, a much more solid local investor base, both including HNIs, including family offices, including domestic institutions. So effectively, this is becoming local for local is a word that I think it used to be global for global fund managers solving for global investors and just happen to invest into India along with other markets. That has implications in terms of product development, in terms of innovation, in terms of what happens when global cycles change and how that has unintended consequences for India. But when you have a large local for local market, local investors raising local money for investing in the local market, and that is where we really see a huge sea change, because we are now solving for local issues, solving for local investor requirements, and that is where the whole industry is now flipped, and that's really giving the fillip to the next leg of growth. The next thing is just the broadening of the product and the asset classes that we are seeing. So Alternative investments, we all know, it's Cat 1, Cat 2, Cat 3 on the AIF, PMS, all sort of, it's a broad spectrum. Just a quick recap for everyone's benefit. Cat 1 typically is where you have angel, venture, you can have infra, you can have a few socially relevant schemes, etc. Cat 2 is typically where your growth, private equity, real estate, credit, private credit kind of strategies. Cat 3 is typically your listed leverage, hedge fund, or long only kind of listed strategies come in. PMS, of course, is segregated accounts. But within that broad framework, what we've also seen is a huge broadening of strategies that have been on offer. And that is linked to the first 2 points. I think I made the first point, which is about the investor barbell, seeking complex strategies, seeking different payoff structures. The second one was the broadening of the mix between what type of manufacturers and what type of investors there are. And both of them have a direct implications on innovation and the kind of strategies that are done. Today, we are in a midst of a unprecedented breadth of offerings within the alternatives platform. You have a bunch of different credit strategies, a bunch of different equity strategies, bunch of different real asset strategies, and each of them I can talk about more. Within credit, you have structured credit performing, you could have special situations or distressed. You could, within equity, you could have starting from the entire life cycle of the company, starting from angel to venture to growth to buyout to special situations. For all the entire stage of the cycle of the company, you have different pools of capital available. You have hard assets, whether it's real estate, infrastructure. Again, within them, whichever type of risk profile, both equity and debt, which is available to investors. We have commodities, of course, alongside within the hard assets. So literally is a plethora of avenues that have opened up, and this innovation which has happened to answer the environment requirement of investors. I will also talk about how we have approached it here in this context, just to draw a parallel within Access. What we've recognized is that this space, it is not a product push space. It's not about coming with one fantastic fund and going and sort of seeking finding investors for that one product, because the mindset that is required here is more of a solutions mindset. What you need is to understand the pain points, understand the risk return trade-offs that investors are looking for, and how you can solve for those things through your products. And what that invariably means is that for the manufacturers, you have to be able to approach it as a platform and not as one product offering or one or two or X number of different product offerings. What we have done, for example, at Access is that our platform today has a number of different offerings. And if I were to name them, we have real estate, both commercial and residential. We have late stage private equity. We have private credit, it's what we call structured credit. We're just getting into special situations or special opportunities. Within the listed framework, we have quantitative and thematic equity offerings. So if you look at it already, then there is a bunch of different offerings with very, very different payoff structures. And what that does is that it allows us to engage with different investors. And we talked about the different type of investors. Institutions have very different wants. Different institutions have different wants. A family office can have very different wants. So it allows us to engage and solve for the different asks for different investors and really work out whatever works best for them. What it also does when you have a platform is also allows you to engage for a number of different partnerships. That's something, again, that we at Access have done in a very proactive manner, where we've done a number of different partnerships to be able to offer different ideas to the investors, and also be open to structuring ideas and doing structures where you can do certain amount of customizations and structuring through the right vehicles which may be available for investor needs. So that's something that, as manufacturers, increasingly each and every one of us will have to be open to do. And it's a very vibrant space that we're going to get into, which will see a lot of innovation. With that context, let me, spend a few minutes in terms of how do investors approach this space. And Aditya mentioned it, and I think there is today, for people, there could be a sense that there is a little bit of, is there too much choice, or is there an element of there being confusion, because just so many things approaching you from so many different sides. So as investors, how do we make sure, or as partners, as distribution partners, how do we make sure that we understand what the objectives are for each of these offerings, and how do we make sure that we get into the right one? I would say 3-4 things that can be done to help navigate this space in the right way for investors. First and foremost, I think the investors need to understand why they are looking for alternative ideas. You know, I mentioned risk return payoff. Let me give a couple of examples. You could capture the beta in market today very easily, right? So for equity products, it's easy enough. Listed equity, capture the beta through a set of passive options which are there. However, what they will not give you is access to, you know, let's say companies that are innovating or in the private market and who are able to potentially grow at a much faster pace. So one use case is that as investor, you understand the power of equity growth capital over long terms, but you want to broaden your equity spectrum from a pure play sort of listed equity to something that goes beyond that into the unlisted side, and therefore that is the with that you try and solve for which offerings can help you achieve that. A very separate, different second kind of a discussion could be that you're looking for maybe as an investor, you have a certain equity cash flows, equity sort of allocations again through listed market, but you're looking for something that can complement that and give you some very reasonable IRRs, but also regular cash flows and also some lack of correlation with equity markets. Therefore, you know, can there be something like a structured credit offering which could help you achieve that by complementing your equity ones? Still gives you reasonable IRRs, but unlike equity, which requires a much longer commitment, can give you some regularity of cash flows to play with. So these are just a couple of very, very simplistic use cases that I've thrown in. But the idea behind saying this is that as investors, first and foremost, we have to really understand what is it that our objectives are and how different products can or different offerings can help us solve for that. The second thing is to also spend a lot of time and effort to just educate ourselves, and I goes back to the where I started, which is, you know, I think it's a brilliant thing by Equalify to get all of us together into this kind of a platform. And I think this area will require, there is no real shortcut. It will require time and effort to be invested by people to really understand the offerings, understand implications of the different offerings. And that is again something that they can really, they will really have to do. Once you have the, in a certain sense, having that education allows you to also better appreciate what may work for the portfolio, what may not work. Because right now, one of the things that we do come across when we talk to investors is that there are certain big sort of rule of thumbs that people make. Okay, how much lock-in is there, or what is the target IRR of the product, and sort of 2-3 big headline numbers can very quickly people sort of use to decide whether or not this product works for them. And I think that can be quite a sort of a self-defeating thing, because yes, you need to know the lock-in. Yes, you should have a handle on the target IRR, but the more important thing is to understand the strategy itself. Where is the money getting invested? What is the asset class? What is the risk that you're taking in? And how is that talking to the rest of your portfolio? And you know, there's nothing to be scared about lock-in, right? If you have a portfolio where out of 100 rupees, let's say 90% of it is into very, very liquid investments, which are available to you on a daily liquidity basis. It allows you a lot of elbow room for that 10 rupees to then get allocated to slightly liquid assets, provided, of course, that the risk return of those asset classes are complementing that core book and is meeting your objectives. So I think too much focus is on lock-in, too much focus on target IRRs, too much focus on the flavor of the month, rather than trying to understand the context of the investor's portfolio. And that is what I would really, that's my last point, that there is no substitute for education. There is no substitute for spending the time and effort to really understand these products and spend understanding these asset classes, and really then make sure that you find the right ones without really trying to get too bogged down with one or two variables within these products. So with that, like I said, this is I believe over the next 10 years, we will see the golden age of alternative investments in India. This is the time for local. This is the time where you'll see the emergence of the big local giants within alternative space in terms of investment houses. You will also see much more increasing sophistication on the part of investors who are going to be able to find much better ways of using these strategies into their portfolios. So I think it's a great time, very exciting times for all of us. And for us as Axis, for example, we have really said that this is going to be a big driver for within our business strategy over the next 5 years, 10 years. And alternative is going to play a very big role within that. So just reflective of what opportunities we are seeing firsthand here at Axis as well. So with that, I'll pause here and give it back to you, Aditya. And thanks again a lot for eQualify team to put this together and giving us this platform and this opportunity. Really looking forward to a very good set of sessions today as well as the rest of the program.
Certainly, Ashwin. Thank you so much for the very insightful talk. It was wonderful to hear how passionately you feel about this sector going forward. And I think that's what I was talking about in the beginning, that, for last few years, it was all about everyone getting amazed by the sheer amount of money being raised by AIFs and the sheer number of AIFs being set up. Now we are increasingly moving towards a more structured approach where we're talking quality and innovation. And, I think more and more players coming in, more and more fund managers coming in with their new approach, I think is a good news, is a great news. Regulators, of course, are doing a great amount of work in ensuring that our AIF markets, especially, I can talk about that because I've been privy to a lot of this discussion, but the AIFs sector especially is very foolproof in its approach. Investors are very well guarded and enough accountability on the part of the players to ensure that nothing goes wrong. So that's great news, guys. Thank you, Ashwin, again for joining in for this session and for the efforts that your team has been putting in to make this event a reality. We look forward to keep engaging with you more and your team members going forward. Audience, we'll quickly move on. I think we are almost into the timing of our next panel discussion. So I will quickly get started with this. Do we have all our speakers here? I see almost everyone. Rajesh, hi, good evening. Good evening, Pranav.
Hi.
Hi, Ashish and Saurabh. Welcome all of you to this only panel discussion of the day. And the idea behind this panel was immediately after Ashish talk was more to get some experts together, preferably slightly representing some different lines within AIF, and to hear from them in terms of what are the exciting things they are looking up to when it comes to AIFs. So audience, the panel, we have a very illustrious speaker list here joining us. Absolutely excited to see two of our winners from the 40 under 40 list as well. So something going right with that campaign for sure, because we've some good movers and shakers of the industry on that list. So we have this panel which is going to talk about what's the next big things that are coming up in the AIFs and PMS space. And we have with us, let me quickly take a minute to introduce you all to the speakers. 1 minute, guys. Yeah. So, so moderating this panel is a dear friend. Before I basically jump into introductions, my apologies to all the four or five of you, because introductions were quite long. It's impossible for me to read out everything. There are a lot of achievements and accomplishments on that. So I've shortened it down. I'll try to make it quick so that we have more time for you all to discuss the topic in hand. So moderating this panel is Mr. Rajesh Gandhi. Rajesh is a partner in the tax practice with over 23 years of experience. He's a partner with Deloitte right now. He specializes in financial services, technology, media, and telecommunications and consumer business. Rajesh has more than 23 years of experience in domestic and international tax and exchange control regulations, advising clients on various tax issues, including domestic and international tax planning, inbound and outbound investment structuring, contracts with foreign enterprises, and taxation of foreign enterprises in India. Rajesh is a member of high-powered working group constituted by SEBI to simplify and rationalize the FPI regulations. He is a chartered accountant and a commerce graduate from the University of Mumbai. Welcome, Rajesh. Our first panelist for the session is Ashish Ahluwalia. He's the Director of Private Equity with Axis Asset Management. Ashish joined Axis AMC very recently in July 2022 as a Director of Private Equity to build and strengthen the firm's private equity and venture capital investing capabilities. He has over 2 decades of professional experience, of which 12 years have been in growth private equity and the late stage venture investing. Prior to joining Axis AMC, he was the global co-head for equity investments in healthcare, food and agri and consumer at CDC, which is now known as British International Investment. Ashish is also a chartered accountant and an MBA from the Indian School of Business, Hyderabad. Welcome, Ashish. Our second panelist for the session is Saurabh Jalaria. Saurabh is a CIO of Incred Alternative Investments. He also heads the SME lending business at Incred Finance, the NBFC arm of Incred Group. Saurabh joined as a founding member of Incred and has over 20 years of experience across the credit and financing business in Asia. He was earlier associated with the Deutsche Bank, where he was leading the private financing and performing credit business for India. Saurabh holds a postgraduate degree from IIM Bangalore and is a CFA charter holder, and also has an undergraduate degree in commerce and accounting from St. Xavier's College, Kolkata. And our third and final panelist for the session is Pranav Pai, who is the founding partner of 3 and 4 Capital. Pranav leads investments and portfolio construction at 314 Capital. As a CIO, he has led over 70 seed and venture capital investments across several investment categories in India and the US. Pranav is deeply involved with the startup ecosystem in India. He served as the co-president of Stanford Angels and Entrepreneurs India and the national vice chairman of the All India Management Association Young Leaders Council. He graduated with a master's in electrical engineering from Stanford University. So thank you all for joining in for this interaction. And Rajesh, I'll quickly hand it over to you to take us go through this discussion.
Right, Aditya, thank you very much, and it's always a pleasure to work with you. And I must say, you come out with very interesting and innovative ways of connecting with the audience and innovative topics, which are always, topic which are hot for the day and very timely. So, this one in particular as well. And so thanks for that, and also for the introduction for all of us. So I would like to welcome my co-panelists, Ashish, Saurabh, and Pranav. Thank you for joining and spending time. Unfortunately, Vijendran could not join us today from Sundaram. I mean, he has a personal exigency last minute, so he had to cancel that. But nevertheless, I mean, we'll start a discussion without wasting much time. And I heard Ashwin talk earlier on the plenary, and some of the things which he said very much resonate with what I wanted to mention. We are touching almost 1,000 AIFs in India today, with investments of over 290 trillion or about 290,000 crores already made. which I think is quite phenomenal considering the limited period of time during which the AIFs have taken off. AIFs now invest in a wide variety of areas, including private and public equity, private and public debt, structured assets, futures and options, and also in a wide spectrum of sectors, including certain new age sectors. So my first question, which I'll start, which will be a little bit broader to all the panelists, will be that, crystal ball gazing, rather, gentlemen, from where we are today, what do you think are the opportunities for growth in the AIF segment? In the sense, how large is the opportunity going from here? And also my related question is, what are investors seeking for this segment to really exponentially grow? Ashish, maybe I'll start with you.
Thanks, Rajesh. And thanks for the team for having me here. I think I'll take the second part of the question first, Rajesh, which is, where are the opportunities? And then, the demand that we're seeing in these segments, especially AIF, and, I'll speak more about that because my background's been in private equity and venture capital, is a derivative of just how, used Indian investors have become over the last few years to equity investing. So, you've seen the growth in the mutual fund industry. That's become quite secular and widespread. And people have understand equity as a mode of value creation a lot more now. What that's done, I think, in my view, Rajesh, is that the supply of capital now is one more widespread in terms of just the number of investors. It's more secular, so it's not sort of in one region or one demographic, and it's way more informed. That's what equity investing and mutual funds have done to the end, and it poses a very interesting challenge and opportunity for investment managers like us. And I think a derivative of that is that sophisticated and informed domestic investors are now seeking access to asset classes, which they've not had exposure to, which are giving them a risk-reward outcome that, publicly traded instruments, whether it's debt or equity, are not able to provide. And we're seeing that level of sophistication. And I think that is really what's sort of driving the growth, and especially in the AIF segment, where I said I have experience. I think also, as investors and as fund managers, arbitrage is constantly vanishing and we're constantly chasing arbitrage. And, as capital markets get more sophisticated, people, try and look for that on the private side. And, in our view, there are, and my colleague Ashwin was speaking about this earlier, there are 4 or 5 very large segments we see, which have largely been governed by institutions, dominated by foreign capital, where we're seeing AIFs being formed and where we're seeing sophisticated investors and informed investors come and ask us for products saying, look, this is where we need exposure, right? Private and equity and venture capital, which is my bread and butter, that's a big area. And, we'll talk about some stats later, but, clearly private companies, high growth, and people want access to those opportunities. And I think the industry, especially over the last 3 to 4 years, has shown that, it can deliver stellar returns, often in excess of what public markets can provide. Real estate is a big area, and I think that's getting more sophisticated. It's a class of risk, again, which often the public markets will not offer, and people are demanding that. Structured credit in various ways and forms, I think it's existed for the longest time, but again, becoming more sophisticated, being offered as smaller units to a class of investors where these kind of products were not available. And the fourth area, actually it's 4 and 5, whichever way we cut it, is buyout and special situations. If you look at alternatives globally, buyout has been the dominant category for decades. It's a very small category in India. It has the ability to generate exceptional returns for investors. And, generally HNIs, even HNIs in India have not had access to that, or, had disproportionately less access to that asset class. I see a lot more opportunity there. I see a lot more in special situations as well. Again, where large distressed credit kind of funds and, for foreign funds have played. But again, there is tremendous sort of return generation opportunity, and special sits, if you look at the global alternatives landscape, is extremely large. So I think overall, these are the 4 or 5 large areas where we're seeing people get more sophisticated and have an understanding and chase alpha. And then fund managers innovating and sort of bringing out more products. And, it's in sync with what Ashwin was talking about, what we're trying to do at Axis as well.
Sure, Ashish. Thank you for that interesting insights. Saurabh, you want to share your thoughts and then request Pranav as well?
Sure. So since Ashish has covered a fair bit on the second part, I'll probably, and I agree. I think all of these are very interesting strategies. It just offers very tailored risk reward for pockets of liquidity that do not have exposure to that through the regular, investing routes. Just crystal gazing into where this industry is. I think this industry is growing at 30-40% by most estimates, right? When we look at the entire mutual fund industry, we get to a number of 37 lakh crore that's raised and invested into Indian debt and equity markets. And if I look at just the PMS and AIF industry, in terms of just the capital that's been raised so far, it's around the 10 lakh crore number, where you have severe restrictions in terms of the ticket size. PMS, as we know, works with a minimum of 50 lakh. AI works with 1 crore sort of minimum ticket size. That's the 25 lakh just got raised into 50 lakhs. And second is a lot of, so it doesn't have access to the retail money. And second is a lot of institutions that have just started investing in this asset class are also restricted in terms of what percentage of their AUM can they allocate to a strategy like this, right? So despite a very nascent industry, I think it's already commanded a fair bit in terms of the allocations that's coming from sophisticated investors. And I think this trend will continue. And as innovation comes up, and as a lot more asset classes open up, I think the overall PMS and AIF industry will increase in size, and there's going to be a place for a lot more domestic players to serve the domestic market. Now at InCred, we firmly think that the first bunch of investors that came into the country was foreign capital, right? Whether it's the foreign banks, it's foreign funds investing in real estate assets, investing into private equity, investing into credit transactions. But if you look at the last 3-5 years, as the industry has grown and a lot of homegrown funds have come up, raising money from domestic investors, that's where the true, I would say, non-FX, non-foreign exchange led transactions are done, because everything that comes in with foreign capital also comes with a 4 to 5% rupee depreciation implied returns, right? And then you're competing with a lot of non-INR capital against this. So I think a lot more capital will be coming towards the PMS and AIF in the next 5 years from both domestic institutions and domestic family offices and private money.
Interesting. Pranav, if you could please add on to this.
Yeah, well, I think I'm very happy to see so much is covered. I'll just speak from a fund manager's point of view. We've seen 3 very distinct cycles in India over the last 20 years, roughly. I think I totally agree with Ashish. CDC was one of the pioneers in the early 2000s to mid 2000s. But if you were a fund manager back then, you had almost no access to capital in India, and all of your capital came from outside, therefore. And that's why the industry was so small. Fast forward 15 years, we have a record being set every year. What we can tell you for sure is the demand for products that AIFs are launching is now across the country. We have inbounds from northeast of India, from Calcutta, from parts that were formerly not part of our world before, the technology, the tech and early stage VC piece. But there are 4 or 5 things that are coming that I think will signify even more flows going forward. For one, I think the largest financial institutions in the country will now start structuring fund of funds that channel more capital from further corners of India, not just the large bulge bracket HNIs, UHNIs, but also investors who want to invest smaller tickets. And we think that should be spread across the product suite, from tech to buyout to real estate to credit. And we think that's a great sign for India, because overall our equity positioning, our equity presence, our equity weightage has to grow from local capital, not just global. Second, I think India's weightage today globally is still 3% of allocations, right? Our GDP, while it's close to 3 trillion and we're either the 5th or the 6th largest country, give or take the quarter, we're still only 3% of the biggest global allocators positioning in across economies. China's around 8, 10, 15%, depending on who you're talking to, with tech or non-tech. So now we need, with this challenge that we have to face, is how does India become 5 to 10% of global allocations? And historically, if we look at the US, we look at China, we look at Europe, any country that's got into double digits in terms of allocation bandwidth, they've had to do it by pushing the gas on local participation in the equity markets. That's the only way to increase the equity market cap, and therefore the percentage that global allocators can channel towards your country. So I think we are in that stage today, where we're going to go from roughly 3 trillion in market cap today to, we have to go to 30, right? We have to grow 10x. And that means the allocation global investors will make to India can grow from 3% to say 7, 8%. And I think that's going to mean the entire culture of allocation in India has to fundamentally change, which is great. I hope all of us get to play a significant role in that big wave that's coming. And I think hopefully retail will play a role as well through structured fund of funds that Indian institutions are stewards of. Lastly, I think the most important thing for us is so far we've had 3 very important demerits to growing large value assets in India, disadvantages rather. One is we haven't had access to quality equity capital over decades. It's changed over the last 15 years, but that's new. The Infis and so on, the Tatas, the Wipros, never really grew with high quality equity capital the way their global peers have. So I think this changes how assets will be built in India. Second, I fundamentally think it's gotten easier to take assets public. It's easier to get assets restructured. Well, of course, there needs to be more improvement. The levers that make the markets more efficient have only gotten more powerful, and that's great for all of us in the markets. But third, the most interesting thing maybe is if we don't have an active presence of fund managers working with regulators to continue to expand the markets, then we would have lost a decade, because this is really our decade to capture. So I think across all levels, from regulation to the innovators that we work with every day, we're seeing fundamentally AIFs play a almost fabric level connective tissue role to bring all of this together. And I think that's why, for me, this decade is really important. I think we become a systemic part of the Indian economy very quickly.
Very interesting and well said, Pranav. And I'll come to regulations later on, but I would want to stick with you and continue with my next question, which is, if you look at overall investment perspective, there are a lot of hot sectors today, whether it is technology, cyber, in manufacturing, that's the Prime Minister's focus area, innovation, alternate energy, retail, e-commerce, you name them. My question is, in terms of upcoming focus areas for AIFs and PMS, what do you think could be one of the a certain few areas where AIFs and PMS will look at focusing?
Yeah, I think that's great. I'll split AIFs and PMSs apart because I think they both fundamentally have different value props. I think on the PMS side, well, I don't run a PMS myself. We have good friends who run large PMSs like Marcellus, for example. Continuously we hear from them that the demand from their investor side is fundamentally very simple, like a 3-ingredient bucket. One is they want high quality people who are consistent in the advice they give and how they select companies and ideas, right? And when things are good, they don't get too aggressive. When things are not good, they explain and are transparent about how they will recover or how they are planning for that downturn. So I think the demand on the PMS manager today, I think we are seeing a very new demand. It's no longer just access and selection and so on. It's the full experience, right? And that's why we're very happy to see that large PMSs are growing unexpectedly fast, from 0 to 15,000 crores, say, for example, in 3 to 4 years. And I think that's a good sign that if you're building a franchise for the long term, PMS is a viable business, a viable category, and there's demand for those services across the country, which is advisory led and so on. So I think it's a sign of a very important step forward we've taken. So the fact that is established today is for me a very credible part of the ecosystem. Now the demand on the PMS manager from the ideas point of view has to expand. Unfortunately, PMS are still being very biased towards quality. They're still picking those same bucket of large caps. When a good analyst report comes out on, for example, Spec Chem became this big thing over the last 6 months. Everyone is buying Spec Chem. So it's kind of a herd mentality still. And we are not seeing that, I hesitate to use the word activist for PMS, but we're not seeing that outlier thinking in the PMS category still. And I think that's important because that's where the alpha in the public markets comes from, by picking ideas that are still not mainstream and pulling them up to mainstream by consistent coverage. So I think PMS managers have a role to play, not just in following a herd and being part of it, but expanding what the definition of high quality is. And we look for, I think that happens specifically this decade. A lot more of them will take those positions. Coming to AIFs, we still don't have the AIF culture that's spread beyond tech and mid-stage PE. I'm looking forward to the day where we will have multi-billion-dollar Indian private equity firms that can command large outsized presence the way the KKRs and the General Atlantics and so on have done in the US and the rest of the world. I look forward to the day where we have AIF managers, India, domiciled here, raise capital here, and can build companies beyond tech. I think we need a massive amount of Indian capital to support everything from manufacturing to chemicals to biotech to logistics. There are a dozen categories that are doing really well in the country, but they still starve for capital. And they're still largely ignored by funds like us because our mandate is tech, right? And of course, tech works certain ways. We've clearly seen the up and down over the last 2 years. But in the non-tech piece, AIFs becoming more mainstream, building, for example, consumer brands, building logistics companies. We look forward to the day that AIFs expand there meaningfully as well. So I think the first wave of AIFs have been dominated by tech and some other categories, obviously. This decade, I hope there'll be large PEs, guys we could look up to as we build our companies up to IPO. That handshake between us and the mid-stage AIFs, I think that's something that we're looking forward to building together. So that I can keep going on, but I think there's a lot of things to be built still. Very exciting things to come.
No, absolutely. And Ashish, from a PE and a VC point of view, any thoughts you would want to add on that? As Pranav mentioned, beyond tech, what are the sectors you would think?
No, I think, the first wave, as Pranav said, has been tech-dominated VC, to some extent, some growth PE. Not to say that the opportunity is less. I mean, that opportunity, let's admit, is very large and still to be tapped, right? I mean, 2021, you're talking about, just VC funding in India being in excess of $35 billion, PE being, an equivalent amount. So that's $70 billion coming in 1 year in just those two strategies, which is still foreign capital dominated. So I think just the scope for participation of domestic capital, very, very high. Just across, what we call startups, this is Pranav's domain, and growth capital. There are about 50,000 companies in India where the collective market cap is about $400 billion. So just that asset class is so large, and it's as we've been saying, it's foreign capital dominated. So it's a very large area. I think the other thing is, and it's again an extension to what my fellow panelists have been saying, the way some of the best alternative assets, different people have done it in different ways. But some people have just specialized in sectors and then built different pools of capital which can address the needs in those sectors, right? So early stage, platform building, there is a pool of capital available provided there's a quality business. You want to add more leverage, you're getting working capital heavy, there's a structured credit fund within the same thing. So it's more relationship driven. You build an understanding around key industries, and then you offer not one pool of capital, which cuts all needs, but differentiated pools of capital to that business. And that's how you start differentiating yourself as an investor. The business wants to make an acquisition, you have a special such funds to address that, right? But it's very, very industry specialization driven rather than, one product and I'm going to try and cut all needs with that. And I think it's what Pranav was saying, right? I'd also love to see the AIF landscape get to that level of sophistication where managers emerge who've got products which are ultimately targeting good businesses. What the need of capital there is, in what shape and form, I think that can be tailored.
Yes, thank you for that. And as I said earlier, my next question is on regulations. And in our country, all of us are some kind of legal experts, and we love law irrespective of what field we are. And this is quite important for the AIF industry also, because in the recent past, we have seen, with the objective of investor protection, increasing compliance, governance in AIFs, there's been a lot of changes which SEBI has made. And some of them are increased disclosures in the private placement memorandum, appointment of compliance officers, routing of applications to merchant bankers, the investment charter, and also proposed changes as per various press reports, which include asset and liability segregation amongst different schemes, outer limits for closed-ended schemes, and also various steps to ensure that there is no mis-selling. So a lot of changes and regulations and more expected to come. There's a worry amongst certain section of investors that probably there's an over-regulation of the industry, and the industry cannot be compared to mutual funds for many reasons. Given the limited time, can all of you share one or two key areas where you think the regulations need to change or there needs to be an improvement, etc.? Maybe Ashish, starting with you, and then Saurav and Pranav as well.
Sure. Rajesh, not an expert on regulation, but I'll take you to, I mean, the growth in alternative assets globally, if you see, right, like these asset classes have existed for very, very, very long, but there were three major events from, what I understand, which really led to the growth. And, the first two were the dot-com bubble and the global financial crisis of 2008, because companies went private and investors did not want to be, or had a pool of their capital which they did not want to be subject to the same levels of volatility, and alternatives allow you to do that. And, my colleague Ashwin spoke about that. I think at a fundamental level, I believe at whichever level, regulations has to be in line and respect that. If you're going to then subject unlisted instruments to the same level of scrutiny, you're taking away the inherent need from investors and the rise of the ethos of why these asset classes exist. So I think that's quite fundamental. On the other hand, I think, look, I mean, we all here know that managing third-party capital comes with a very high degree of fiduciary responsibility. The good thing is, and again, I speak more of PE and VC asset classes, the foundation of those asset classes was laid by foreign capital and very sophisticated foreign limited partners, where I think very good standards of governance have already been set. And there are fund managers who are sort of used to that. I think that sort of is a good platform where people can today claim that they stand up to global levels of diligence. I think as a general direction, just keeping in mind of not subjecting and sort of painting everything with the same brushes is fundamentally important.
Thank you. Saurav, your thoughts on regulations?
Yeah, so I think, regulation by and large is good, right? I mean, it kind of legitimizes an industry when the first bunch of funds come up and people who are serious about this industry understand that if you're not regulated, you'll have some bad examples and investors will lose money or the fund will not do what it's committed to do. So regulation is good. And generally, we by and large think that some of the regulations that have come up in the last few years are to increase the transparency towards the industry and in the eyes of both the investors and their advisors. We do think as a house that there are quite a few things which we would like to lobby for changes, and especially on the debt funds, the category 2 debt funds. One is the tax rates, which is mutual funds on the debt side are subject to a much lower tax rate versus an AIF. And by and large, they kind of achieve the same purpose. So why is the tax rates very different? Or for example, SEBI prescribing what percentage of the portfolio should be in listed versus unlisted instruments, right? I mean, these are all subject to the manager's discretion. And as long as like-minded investors are willing to commit to that strategy, then that's something which SEBI shouldn't dictate the percentage of listed versus unlisted investments into a fund. So I think there are quite a few things where they need to open up to the idea that there could be a totally different strategy from an existing mutual fund. And as long as it's well disclosed and investors are willing to back it, they don't need to regulate it at a central level and let the accredited investors or people who are eligible to participate in that fund kind of make that decision. So I think these are some of the things which we think should come in. I do think though that some of the other regulators, for example, whether it's RBI, whether it's EDA for the purpose of insurance companies, they all need to come together to say whether the risk weighted assets of a banks that are investing into AI should be any different versus, let's say, if they're investing in a regular fund, or for ADA to say X percentage of your corpus can be allocated to alternatives. So some of these will eventually happen with passage of time. But I do think it's not just SEBI as a regulator, but ADA, RBI, every single regulator in the country is responsible for ensuring this industry or this asset class gets its due recognition or kind of becomes more mainstream than what it is. So for sure, good to get regulated, and similarly, lots of points that we would probably want to lobby and say this should change in the longer run for this industry.
Good point, Saurabh. Thank you. Pranav, you have some thoughts on regulations?
Yeah, very quickly, I think we've had a good regulator overall compared to what it could have been. It could have been much more controlling, could have been much more permission-led. So I think largely, if we have to account and give credit for the growth that we've seen in the AIF category, it's thanks to good regulation, thanks to obviously good leadership at the center, and of course, a good coordination between the other regulators, central bank, and so on. Where I think we have reached today, I can tell you for sure, in meetings across the country, no one expected the AIF category to grow this fast. So it's largely been a positive surprise. And of course, the multiplier effect that AIFs have had on job creation and inflow of equity, FDI. We had a record FDI last year, largely attributed to tech, VC, and PE, of course, the value creation in the public market. So I think the AIFs now have to be viewed as a systemic player, which they are getting to slowly. And therefore, the few niggles here and there, right? The over-policing of ratios and the concentration limitations and so on. I think if we're able to make a concerted effort, those should be eased out and more trust should be placed in the fund manager. I think that's the transition we are making. And in the backdrop of course, India's economy is moving places. Our allocations globally are going up, like we discussed before. So I think it's just a matter of time. I hope we make that transition quickly. And then it's up to the industry, of course, to prove that trust was well placed. And I think we're in a good position to do that.
Probably, what they have done with the GIFT City is to alluding to what you mentioned, and maybe that's a test case which they will broaden to the whole of India. Now, sticking to some of the challenges, apart from regulations, fund managers and investors face various challenges, whether it relates to the macroeconomy, the structuring of investments, the market pricing, etc. There could be many challenges. According to all of you, if you can name one or two areas of challenge for fund managers and for investors, which need to be considered as we move forward, apart from the regulations. So, Ashish, maybe you want to start again.
Sure, thanks, Ajit. I mean, quick two things for me on that, two challenges from an investor's perspective, two from managers. I think, and this is more AIF, I think just making investors understand, what a closed-ended product is and that you're committed to a strategy for a longish period of time still requires a lot more education. It's fundamentally different from, other asset classes, liquid asset classes. I always explain it. I mean, it's a PMS and listed is sometimes like watching a movie. You don't like it, you can walk out. AIF is like signing up for a football game. You don't walk out midway. You've got to play the full game. And if you like that, then that offers a level of satisfaction that's higher. I think the second is longer tenures. You're committed to strategies, and I think just more education on that from an AI perspective is an ongoing exercise. And I think that is bound to continue. I think from a manager's perspective, balancing domestic flows and foreign flows, the asset classes we're investing in, it's still subject to significantly higher foreign flows, and how we sort of match domestic flows, and it ultimately affects the prices of assets that we're investing in. I think that's quite critical. And I think investment mandate, stated versus actual, and I think that's what's going to separate a lot of people, which is, what have you stated and then what are you doing? And just having that level of discipline, extremely important from a fund manager's perspective.
Pranav, thank you. Pranav, your thoughts on this, please.
Yeah, I think it's mostly to do with the micromanagement of how we deploy. I think Ashish and Saurabh covered that well. So, for example, as a fund manager who's got 6-7 schemes, trust track record for over close to a decade now. We passed the exams, etc., etc. Now, why are we not allowed to have a single company SPV? So say we have a good company and 4 of our LPs want to invest in that company and have us manage it. We're already required to be PMS aligned and so on. That regulation came a couple of years back, but we're still not allowed to buy the stock of a single company, right? And it's an unnatural restriction, if you ask me. And then we have to get creative with going to Singapore, and then it unnecessarily diminishes the powers of a good fund manager in the country and the ability of a good company to raise capital from Indian investors. These limitations don't apply to foreign investors, for example. So I think we have to reach a point where, like I said before, there's an element of trust between the regulator and the market participants, that we're doing these things with the right framework in mind. We have adequate boundary conditions, and we have to be allowed to be run our portfolios the way they are run globally. So I think we'll get there soon, but again, just minor things that get in the way for now. I think long term, again, we're fairly optimistic that regulation is in the right direction, and of course, it's been very consultative, very positive to work with.
Yeah, thank you for that. Saurabh, your thoughts on this?
Yeah, I'll probably mention 2 points. One is for specifically closed-ended funds. I think it's the liquidity. I think Ashish alluded to this earlier. And maybe at some stage there is there's a secondary market for unlisted companies. Maybe there's a secondary market that gets created for illiquid units of a particular fund, right? So I think that's going to make a big difference when people think they want liquidity and they can kind of get out, maybe at a discount, maybe at some level of haircut to the NAV. So I think that's one. And I think the second is the standardization. So I think as an industry, we still go through every PPM scheme needs a specific approval, and it depends on who's the relevant SEBI concerned officer and what their sort of overall views are on certain languages within the PPM scheme, to the entire administration part about fund accounting and how do investors get a particular statement of a particular fund. So a lot of the standardizations can be made across the industry, so that if me as an investor is investing in 10 different AIFs, I know how to monitor and sort of look at them in a consistent manner, rather than every sort of fund reporting it in a different way. So I think some more standardization will probably go a long way in terms of more investor appetite towards this.
Interesting. One of the things which we haven't mentioned about or spoken is on the increased focus on ESG, especially globally, and also with mutual funds. ESG and sustainability, and this is a demand partly coming from regulations, partly coming from demand from investors. Do you think in the AIF world, we will see that anytime soon, whether on a voluntary basis or on a forced basis, schemes or funds which are focused on ESG and sustainability? So Pranav, maybe starting with you.
Yeah, I think that's really important. India has this unique position in the world where you just couldn't do business here if you weren't already ESG sensitive. You can't take risks with people's data, for example. That's always been true here. You can't take risks in insurance, for example. It's tightly regulated. Obviously, that's very strictly enforced. So we have no choice, if we are in asset management, to be very, very clearly focused on ES and G. Of course, E less in tech, because the environmental footprint isn't as high as other operating sectors. But overall, this is something that we thought was very natural, especially to venture capital. So that's why we've taken ESG very seriously since we started. We launched our first fund in 2015, and we recently got approved as the first VC signatory to the UN PRI from India. We think that's not atypical now. Almost every Indian AIF manager we know in tech is gearing up to become scrutinized as far as the ESG lens is concerned, and make a very simple, straightforward claim to being ESG aligned going forward. And I think that's a good thing. It allows India to leapfrog from a perspective of global allocators. This is an advantage we have against other emerging economies, for example, like Indonesia, China, large part of LATAM and Africa. So I think this is India's moment to shine. We really should grab that and take full advantage of it. There are obviously execution problems in ESG. Some of the frameworks built for ESG really apply to large public companies. They're very useless when applied to small private companies like what we deal with. It's not my opinion, it's a truism. We've tried to apply those, they make no sense at all. There's some amount of refactoring and alignment required, but again, that's not something that's impossible to do. There are enough ecosystem players to do that. I think we can have a very thriving industry that's ESG forward, with India setting a new bar for what sustainability looks like. So we're excited. We think it's a good thing when applied correctly. We think it's a good thing when contextualized to India and the asset class specifically. And we think it's a good thing if India is able to make a collective positioning for the entire country's asset management as far as global allocations are concerned.
Thank you. Ashish, any quick thoughts from you on ESG?
I think two quick thoughts. I mean, one, the G is non-negotiable in India anyways. You can't compromise on it. Good fund managers have always known it, focused on it. ENS is very subjective. It depends on what your investors are asking you to do. Will we see more demand? I mean, fund managers, are just going to be more conscious about it. Whether we'll see investors demanding products, I think we're waiting and watching. I think some part will be driven by regulation, some whether investors want their portfolio managers to really manage, that aspect apart from returns for them. And, globally, the jury is divided on that. I would say still behind, the global flow of capital into ESG. But, it's going to come in phases, in my view.
I have one question which, one of you could answer. Sorry, we have limited time, but I still wanted to keep that. Is that, speaking of technology, and if we look at in-house, then where do you think will technology play a role in-house? Whether in terms of fund management, fund operations, investor reporting, where is there a greater need for technology? And again, crystal ball gazing, where do you think technology will play a bigger role? Any of you, please.
Yeah, I can take that. I think the holy grail is when we have transparent full stack reporting, like companies actively fill in invoices, orders, payments, vendor allocations every day. That bubbles up to the investors, all the shareholders, and that bubbles up in our reports to our investors, right? And then so on and so forth. But I think that's a long way away anywhere in the world. No place in the world has had that full stack flow that way for many reasons. And I think where technology plays a role now is, number one, for sure, in helping the fund managers ourselves, working with our regulators and making sure that the flow of information, the filings, and so on become totally run by machines. So, for example, when does your PPM get filed versus when does it get, how many days you have for review versus when does it get approved, and when is a deemed approval that's come by default. All that has to be run by logs and so on. And I think that's already starting, where there are already some things that are surprisingly under consideration for deemed approval, which weren't even 5 years back. So I think technology plays a role in making the interface between the system and us much, much clearer. I think then with us and our assets, our portfolio, and then hopefully eventually over the long term, a full pipeline. But until then, I think we have to use technology realistically and not have imaginary issues like blockchain and all, for example, a long time ago.
I think what you have said is quite exciting for me as a professional. I mean, I thought you might say something of use of technology on fund management, but when you talked about regulations and reporting, it was exciting for me, and all ears on that. Look, I think Saurabh, Pranav, Ashish, all of you have given very valuable insights on this panel today. I'm glad Aditya has recorded this. It is going to be available on YouTube. So those of us who couldn't attend and listen will be able to do that at a later point of time. Very useful insights from all of you. And I'm also sure that if somebody listens to this after 3 years, 5 years, whenever, it will very much resonate in terms of what you all have, predicted and shared your views on the future in terms of what is actually going to happen. So once again, thanks to all of you, Saurabh, Pranav, Ashish, for spending time on this session. I enjoyed it very much, and I'm sure the audience did as well. And with that, Aditya, back to you.
Thank you so much, Rajesh, for moderating it so well. Pranav, Saurabh, and Ashish, for joining in with your views and time. Audience, I would have loved to open it up for some Q&A, but we are absolutely out of time. So I believe I mean, I'll just like to request all of you to reach out to our speakers. They're more than happy to connect with everyone, and happy to always answer queries from the industry participants and friends. So please do reach out to them for now. For now, we'll have to move on to the next session quickly. Thank you, panelists, again for joining in. I look forward to keep engaging with you guys on more such sessions.
Thanks, Aditya. Thanks, Rajesh.
Thank you.
Audience, so here now we start off with our showcase sessions. As I said in the beginning, the idea behind this entire initiative was to bring together exciting investment opportunities, products and strategies on one platform, and put it up for the investors as well as advisors. Gives me great pleasure to kickstart this very first showcase session in our history. And here for us, for the session, we have with us Mr. Hitesh Zaveri from Axis, who's joining in. So Hitesh, can you?
Hi, just give me 1 second. Hitesh will join. Just
Okay.
1 second.
Sure. So audience, will just wait for a couple of minutes before we get started with our showcase sessions.
Hello, good evening, everyone. Hello.
Yeah, hi, Hitesh.
Hey,
Welcome.
hi. Thank you.
Thank you for joining in. We are we'll quickly jump into the session, Hitesh, if you've settled down. So I'm sure you know the background. This entire initiative is designed around showcasing interesting investment opportunities.
Okay.
And yours is very, very first session in the history of this, our organization as well as this initiative. So welcome.
Can you, I'm sorry, can you elaborate? What do you mean the first session in the history?
Okay, so this is the inaugural edition of this program where, so we conceptualize this entire initiative to create an annual platform where we want to showcase year after year, we want to showcase exciting and innovative investment products and strategies across 10 different segments. So today we're talking about AIF and PMS. Similarly, we have 9 other segments talking about other asset classes. And all this, this entire event is going to run till August 12. So first day of the first edition and the first showcase session. So welcome on board and, happy
Thank
to create
you.
history.
A couple of questions though. As of now, it's how many people in the call right now at this point?
That we'll have to see. So we have roughly 2,500 to 3,000 people registered for this entire initiative. And last I checked, when Ashwin was speaking, we had around 600, 700 who had logged in by then. So we'll have to check because the audience is logged in through a separate platform. So you and me are here on Zoom. The audience is logged in through an event platform separately.
Got it. And then and the only thing I'm doing today is talking about the New Gen India product, right?
Yes. So the Axis Next Generation India product, and as I said, the idea behind showcase sessions is to just talk about the products, and the strategy behind it or the approach behind it. So I believe we already overshot the start time. I'll request you to quickly get into it. Is there a PPT or presentations?
Yeah, we will share the screen. So am I well visible properly on the screen and stuff?
Yes, you are.
So we'll share our screen.
One sec. I'll just make you the co-host.
Sure.
And so we are running a bit late behind schedule, but we have around 15 minutes for the
15
session.
minutes for the product?
For the session. Because we have kind of allocated 20 minutes, but we already 7 minutes behind schedule, and there are back-to-back sessions. So,
and is there a Q&A? Should I be leaving some time for Q&A?
If you can, fine.
Okay.
Otherwise, we'll have to cut short on that.
Got it. Okay.
So I have made you the co-host. You can get started.
So why don't I introduce myself and then we'll share the screen, right?
Okay,
right.
I think I should do that because we just got talking and I completely missed out on that.
Okay.
So, so audience, so Hitesh, I mean, of course, we've already, all the speakers are clearly introduced and mentioned on our website, but still, I'm not going to jump into the entire profile of Hitesh. It's quite long and illustrious.
No, just 2 lines.
Head of,
please, just 2 lines here.
Correct. So he's the head of listed equity alternatives at Axis Asset Management. And he's someone with more than 25 years of experience in portfolio management, investment banking, and equity research.
Right.
What you should definitely know is that he's done a general management program from Harvard Business School and an executive development program from the Wharton School. Now, these are the kind of names we all, have aspired to have on our profile. So lovely to have you, Hitesh. Over to you. Yes, and we can get started immediately. You're the co-host now, so you can share your screen.
Sounds good. Good evening, everybody. It's great to be here and, lovely to be talking to all of you. So what we are going to be doing today is talk about the Axis New Gen product, which is just getting launched as we speak. What I'm going to do right now is, dive right in, show you the many of the slides from the deck and share with you what the product is about. Now it should show up on the screen. Can you please confirm?
Yes, it's clearly visible.
Okay, perfect. So this is the Axis New Gen India Fund, and actually we are rather excited about this new Category 3 fund. And what is exciting to us about is that to our mind, it's an innovation in the category, in the sense that in the bottoms up exercise that we did very recently, around 2 to 3 months ago, and where we actually looked at India's market bottoms up, number one. We also looked at what will be the growth prospects for the Indian companies in the context of the GDP rise of India over the next 3 to 4 years. What are the industry dynamics of in many of the industries, and in the underlying context, in the underlying situation where India's GDP growth has been powered a lot in the last 15-20 years with knowledge, with IP, with innovation and technology. Now this for a long time, we have been hearing that India consumes much less of per capita of everything, be it textile, be it, think of a product, any FMCG product, any consumer product, for that matter, even, per capita, cement or anything. And therefore, that has been a driver of growth, and which was true. Having said that, when we were looking at for example, the 5 trillion GDP forecast for India for FY28 by IMF, and then looking at, the very interesting feature of India having crossed 3 trillion in GDP this year, that incrementally speaking, from 2 trillion to 3 trillion, what was incrementally different. from 3 to 4 trillion and 4 to 5 trillion incrementally, what is likely to be different, and inside of that, which industry will benefit. So that was the background. Let me and I hope this slide is very clearly visible to everybody. So this is what I alluded to, that we are, all of us are very lucky in one particular sense, which is that we are getting to witness a very historical decade for India. In this decade, India has crossed 3 trillion in GDP. In this decade, India will be crossing 4, 5, and most likely $6 trillion landmark. For those inclined more about the numbers, as much as we cross around 5 trillion by FY28, in nominal terms, India has been kind of growing at around 6 to 7% GDP, and our inflation rates have been close to 5%, and then that getting compounded for 2 years, and that is how prior to 2030 we'll be reaching 6 trillion in GDP, and which is an extraordinary feat. And just to repeat myself, we are lucky to kind of witness this extraordinary decade. However, when you, for example, look at the last 20 years, and I do remember being present at one NASSCOM McKinsey event in '98, when McKinsey team announced that Edge versus Indian IT doing $3 billion in revenue. The forecast is India will do $50 billion in revenue in Indian IT industry in 2008. And then there was 2002 report saying 11 billion will become 60 billion by 2010, 2005 note, the NASSCOM McKinsey report saying that 21 billion will become $150 billion. And finally, what is there on your screen, that the Indian IT industry, which was roughly around 147 billion, 145 billion in 2015, is forecast to become between $350 to $400 billion in 25-26. India's pharma industry, became 10 times in the last 20 years, and it is slated to triple by 2030s out. Similarly, in my younger age, I recall all the chemicals and specialty chemicals for years together were single-digit PE stocks, as versus that on an average they are 35 PE stocks today, and there's a reason for it. Reason that India has actually gone up the value chain, gone up the complexity curve, and then making much more complex things. And there is a lot more tailwind that India is having on account of global procurers, trying to de-risk their supply chain, something that we have heard a lot about over the last 1 year, last 2 years. The China Plus One policy, and of course, there's the PLI angle in many of this as well, including specialty chemicals. We are also lucky in that sense to witness one extraordinary transformation, which is that it was the last time, more than 100 years ago, that we transitioned away from horse-pulled, vehicles, if you will, to internal combustion engine and ICE engine. And lifetime, what we are witnessing in the 2020s is a very powerful shift towards EVs, and it's a lasting trend which will be there for another 15-20 years as we transition more and more and more towards EVs. So in short, when you put all of this together, and not just these 4 industries but more, is that very powerful trend has begun in India for almost 20-25 years now, where the incremental GDP growth is meaningfully contributed by knowledge, innovation, IP, and technology. And that is what, as we in our research, look forward, that is what our growth is going to be driven by. Now, tech and IP and knowledge is there, it has been there, and so on. But what it needs is few other very powerful ingredients. And India can supply those. Number one, powerful is that people, high quality entrepreneurs who are tech oriented, who are technocrats, who can leverage the knowledge in IP. So what we are finding is that Indian entrepreneurship, as probably pioneered early by maybe Narayan Murthy's and Azim Premji's and so on. But the reality is that when you look at last 10 to 15 years and number of Indian companies that have become billion-dollar companies, very diverse companies, people have come from very diversified background, no longer bonded to a family to be successful, but pure entrepreneurship, that is one. And that trend has been actually further exacerbated by what we see in terms of unicorns that have been getting born almost every week in India, bearing maybe last 3 months because of the meltdown that we have seen, or the meaningful correction that we've seen, which was probably warranted. But all of the last few years, we have seen a number of unicorns getting born, again, a testament to the Indian entrepreneurship. So there are these global technologies and innovations and IPs that are available that are getting exploited by entrepreneurs. What they need as well is good quality capital. And what has changed in India over the last maybe 20 years, and if anything, this trend has got substantially intensified in last 5 to 7 years, is availability of the funding ecosystem, private equity, venture capital, and so on, and capital markets. So when there is a bright entrepreneur and there's a great opportunity, then there is opportunity for the business to get built, because you are going to get funded, and that's very important. So there is another ingredient in addition to the entrepreneurship. And lastly, another ingredient that in a country such as India, I would argue, is needed, which is a very powerful government backing and the business mindset of the government. In the sense that, when was the last time that all of us recall government was giving an annual update about what is our ranking on ease of doing business and so on and so forth, or number of people who are now been digitally enabled and so on. In reality, tens of thousands of businesses in India have gotten built simply because we have a very powerful digital backbone. KYC can be done, and money transfer to people because of UPI and Aadhaar has become much less risky. In fact, it is very smoothly enabled, which is a very powerful a tailwind that has been now been built. So when you put all of this together, we did a bottoms-up exercise when you looked at all companies in India, more than 1,000 crores in market cap, and the around 65 industries that they belong to. And our research was that which are the industries that are going to be most beneficial as the GDP goes from $3 to $5 trillion through, and that's not very far. We are in FY23 already, and we are looking at FY27, 28. So it's not too far-fetched in the future. And there are a number of industry research, in various industries that kind of can tell us that over the next 3 to 4 years, which are the industries that are looking more interesting. With that in mind, we narrowed down to these 7 industries where the knowledge, IP, innovation, technologies in banking and fintech, in tech and IT services, the healthcare and biotech, chemical, specialty chemical, internet e-commerce, automotive, mobility services, and omni-channel retail. There will be many industries, to be sure, because our industry is India as a country is going to be almost doubling our GDP before the decade is out. Then there are going to be many industries. Though in our view, these are the industries where there is going to be a lot of scale. There is going to be good quality ROC, ROICs, profitabilities. High quality management teams are available to exploit the opportunities, capable of taking their offerings global, cross-border and so on. In addition to the fact that we are all these industries are going to be a very large domestic market. Obviously, in continuation with the high GDP growth, there is also going to be what goes hand in hand is much higher per capita disposable incomes. India as a society, we are going to have lot many more prosperous families and households versus with every passing year. And so what the new gen, and so what the fund is about, it's actually India which is new gen. Incrementally, India's GDP, it is where it is coming from, new gen industries, and we have seen the evidence of the past 20 years. In number of industries, it's actually as versus we consuming more plastic per capita, more textile per capita, more cement per capita, and that will continue for sure. And that is what has powered India's GDP meaningfully also. Just that incrementally speaking, we find that knowledge-driven and IP-driven industries are actually going to, have more powerful an impact. And good news about these industries is that the number of players, which are in the pipeline, in addition to the already who are there, they provide very interesting, rather interesting array for investors to, to pick from. There is enough selection opportunity for somebody to build a portfolio, and that is what we are excited about. What I'm going to do is, in the interest of time, I am going to skip the individual industry slide, which is about, however, we have all seen how banking in India has dramatically grown, and then how valuable our banks have become, and the impact that fintechs have been having on diverse sectors, in terms of payment, in terms of lending tech, in terms of pay techs, and insurance tech, and insurtech, and so on, and enabling. I mean, there are literally few dozen sub verticals here when it comes to payments. So very large space, and looking very exciting. India's IT services and IT products and so on, our engineering services. Again, we have been having ongoing numbers to look at, and as companies report to us that, as for example, TCS CEO said that after 25 billion revenue, our next target is, we are looking at the next 25 billion. So, so industries forecast, to grow to $350 to $400 billion by 25-26, and again, looks pretty exciting with high profitability, high cash flow generation, high ROICs. Healthcare and biotech, again, as as country gets prosperous and our healthcare industry, gets more and more informal, we are seeing rapid growth in this industry. And plus, of course, there's the export angle. In addition to what companies have been doing, focusing a lot more on innovation and IPs, and more in licensing and out licensing deals, spending more on R&D, very healthy M&A pipelines, and integrating themselves more and more in the global R&D supply chains and so on. So again, exciting growth ahead for them. All the companies that you see on your screen on the right hand side, just to repeat myself, they've become 3x in terms of P multiple. 10P companies and 12P companies have P is almost triple, and for the right reason. Over the period of time, these companies have pursued far more complex chemistries. They have become more scale oriented. And when we speak to these companies, what they talk about is that, the edge versus doing number of pilots by large global buyers over the last, 5 years, 7 years, 10 years. Currently, the conversation is that whether India can supply more and more to them. And all of them, therefore, the reason you see them to be in a high capex cycle, high continuing capex cycle, and so on. So exciting growth ahead for them. I mean, I will not even spend a minute. All of us have seen extraordinary numbers, and plus, as we transition from 4G to 5G, and our data costs continue to be one of the most inexpensive in the world. And as we get more people on the digital ecosystem, this space is it will continue to be a high growth space. We are transitioning, and there will be new winners and some losers, but this space is exciting for the many of the incumbents as well as the new players. Again, in India, we see our behavior has changed versus what we were doing, even 6 months ago, 1 year ago, 2 years ago, being willing to buy our critical pharmaceuticals from e-pharmacies, our groceries. Now we prefer to order that will come in 1 hour as versus ordering on Amazon, which will take 2 days or 3 days. number of things, that are changing, and even company like Titan, for example, will tell you what is the digital and as a proportion of sales and how is that changing, which is very interesting to know that for the breadth of the industry, the conversation is whether Nykaa is going to be a brick and mortar company in addition to being a digital native, and how quickly they want to grow, and so very dynamic place ahead, and looks exciting to us. So in New Gen India, what we want to do is we want to offer investors a choice to exploit this market inefficiencies and participate, help our investors to participate in the structural changes that are taking place. There are a number of opportunities available. What we are doing that in this fund is that in our view, the 7 industries that we are going to be focusing on are the ones where in our view they're going to be acting as a kicker in terms of a portfolio return potential. In addition to that, we will be investing between 0 to 30%, up to 30%, in pre-IPO situations. Not unlisted, a company that doesn't plan to do an IPO, or a company that might be doing IPO sometime in the future but not clear. We are interested in only those where IPO is clearly thought out. Bankers are already in the room and conversations are on, and and IPO will be taking place inside of 1 year and so on. What we think in this particular situation will help is the way valuations have corrected in maybe last 1 year or so, after the debacle of Nykaa listing and Policybazaar and Zomato and many others. There has been a crackdown on strong valuations, and we also hear that in early stage, or rather the late stage investing, there have been many down rounds and so on. So we think that if the valuations correct there, it will be good for those who are interested in doing the pre-IPO investing. So these are the 2 kickers which we think will really help the returns of the fund, and that essentially what the fund is about. That incrementally, as the nature of India's growth changes, there should be a product to help the Indian investors keep pace in that new reality, both in the listed space up to 70 to 80% fund where most of the action will be, and will be very liquid fund, but also participate in companies which have got incubated last 5 years, last 10 years, last 15 years, who are almost there with regard to doing an IPO, and make that product available. So that is what we want to provide. We will make sure that we work with only those companies inside these industries where the operating dynamics are rather beneficial. After doing this exercise, the rest of the investing filters do apply. We are valuation conscious, and it's not we are not necessarily going to go after very high PE stocks and just for the vanity. It's a very value conscious mindset, which will take more work, but that is what the inclination is towards. So with that, I'm happy to pause. I think I have taken the time as allocated to me, but happy to elaborate on any particular point here.
Yeah, Hitesh, thank you so much. We would have loved to continue with this product, but unfortunately we are really out of time. The other speaker is here waiting. So audience, I hope you enjoyed our first showcase session, and the details about the Access New Gen India Fund. Please reach out to Access AMC team if you want to know more. And Hitesh, can audience reach out to you per se on LinkedIn, or anyone else from the team? If there are some contact details, it will be easier.
Yeah, our product team will be the best. I think on LinkedIn there are a number of Access senior people available. So
right.
Yeah.
Super. So thank you so much, Hitesh, for taking out time. All the best for your Access New Gen India Fund.
Thank you very much.
Thank you. Anunay, hi, good evening, welcome. Just give me a minute, we'll get started.
Yeah, sure.
In the meanwhile, I'm making you do you have a presentation of PPT that you'd like to share? Anunay, are you there?
I'm there.
Yeah, is there a PPT or a presentation that you'd like to share?
Yeah, we have a PPT and
Okay, I've made you the co-host.
Okay, sure.
One sec, I'll just take another minute to formally get it started. Till then, you can share the PPT.
Oh, yeah. Can you see this?
Yes, we can see this. All right, audience. So without wasting any more time, I take this opportunity to welcome Mr. Anunay Kumar. He's the President and National Sales Head at IIFL Asset Management. Anunay has more than 2 decades of experience in corporate banking, retail banking, wealth management, and asset management at senior leadership positions, and has handled both B2B as well as B2C segments. Prior to joining IIFL Wealth, he was associated with Invesco Mutual Fund as Director and Head of Sales. He's also worked with DSP BlackRock Investment Managers, Royal Bank of Scotland, Citibank, and IDBI Bank Limited. He's an MBA in Finance from NIILM, New Delhi, and is a commerce graduate from Punjab University. Welcome, Anunay, to this session. And Anunay is going to speak about the IIFL Phoenix Fund. And Anunay, we have around 20 minutes, 15 on a shorter side, 20 on a higher side, for you to talk about the products. If we have some time, then we can take the Q&A from the audience towards the end. Yeah.
Sure, Aditya.
Over to you.
Yeah, sure. Thank you, Aditya, and a very good evening to everybody. As Aditya did mention that we are talking about a fund which is our IIFL Phoenix portfolio. But before getting into the fund's contours and what the fund is all about, let's talk about the basic principle of wealth management, and very nicely being stated by Sir Warren Buffett when he has said that the very first principle of being in a wealth business is ensure that your clients do not lose money. And the second principle that he has been very advocating about had been that, never ever miss following the first principle. So basically, let's start something around that part only. I'm sure as we look into the markets of today, one thing is pretty much concerning, which is where are we? Is it adequately priced? Are the markets expensive? Are the markets cheap? And I'm sure this is one question which is bothering, irrespective what segment do you belong to, if you're an advisor or a client or even a manager. I think it's bothering everybody. So what we tried doing it, we just tried to put some rationale and some dots around it. And what we have done, instead of price to earning and other contours that the market do look at, we are talking about a price to book, which is basically talking about what kind of price are you ready to put, looking at the intrinsic values of the companies. And if we go back and look at last 20-22 odd years, what we have seen is that at an average, the price to book is close to 3.1. This slide is a little dated one. As we talk today with the recent rally which has happened, the price to book has now gone to 3.3, slightly more than what an average has been. But let's build on this case of price to book, and let's draw one standard deviation negative and a one standard deviation positive, and looks at how do we build the range. So assuming one standard deviation negative comes to 2.4, one positive goes to 3.8.
So basically this becomes the range for the markets to behave in last 22 odd years. But interestingly, if you would have seen, there are 7 occasions where the markets have fallen meaningful. Now, what do we mean by meaningful? We basically are talking about markets fall in excess of 30% if we look at from the highs. And there were 7 instances in the history, and the recent one was in 2020 alone. I'm talking about a pandemic time when market actually come to 1 minus standard deviation. But interestingly, what market does is it doesn't spend long time over there. So the moment it is 1 minus, which is a less than 2 kind of a price to book, it doesn't spend more than 5% of a time. But anybody or anyone who is able to capitalize at that point of time on the market is going to see around 40 odd % kind of a compounded annual over next 5 years. So this is the beauty of 1 minus standard deviation, that the market doesn't spend enough time, but the rewards are phenomenal. And if we go just the opposite to that, and we see someone who is entering into the market at the highest possible level, which again was a very recent one in 2021, when the market actually touched around 3.7, 3.8 on a standard deviation, which is on a price to book. Again, market, just like less than 2, doesn't spend enough time, but the returns also are pretty muted. So one thesis which comes out very clearly from these 2 data points, that if you take a 5-year view on a market, even if you are entering at the highest possible level, your probability to lose money becomes 0, and you still end up making, say, 4 to 5 odd % kind of a money on a compounded over 5 years. Yes, it may not be the real growth of the money, but yes, the money still had grown. Now, if I take away those 16%, which is a 5 on a lower side, 11 on a higher side, and we are at an 84%, that's where the market spends most of its time, which is a price to a book between 2 and a 4. And if you see the median return for these times is anything between 11 and 12%. Now, as I understand from Aditya, we have all possible audience of every category, which is we have the HNIs, we have the distributors, advisors. Now, if you remember, any one of you who approaches a client and says to them that, look, equity as an asset class, A is a long-term asset class, and a B, if you are investing in that asset class, you should have an expectation anything between 12 to 13% compounded. Now that word of 12 to 13% compounded wasn't coming on its own. There was a reflection of a science for that, and the science is this only, which is 84% of time market actually spends between 10 and 13, and around median being 11 to 12%. That's the return expectation that actually we build when we all, and every time when we approaches a client. And that's what an equity asset class is all about. So today's time, if you look at a 3.3, we are neither expensive nor a cheap market. And hence it's become very, very critical as an advisor when we are approaching to the client to offer him something where we see the downside risks are limited. And that's where the fund, which is the Phoenix Fund, is coming into effect. Now, what if I look at Phoenix, what it talks about? It basically talks about identifying the turnaround stories. Now, during the pandemic times, and I'm pretty sure many of us have witnessed that the great companies weren't able to, give the kind, were not able to generate the kind of top line that they were generating in the past because of the reasons beyond their control, and that has resulted into a contraction in the profitability, further resulting into ROEs, and the company's prices started declining. So these are the classic cases, but were there anything wrong with those companies? Answer was not. It was basically the situation which got created because of which, the performances started showing a muted note. Now it could be, so these kind of stories can be of any reasons, can be because of any reason. It could be capital allocation was suboptimal, promoters weren't ready to, infuse capital. There could be some regulatory changes which could result, some behavioral ones, maybe weak economic activity, as I was mentioning during the pandemic. So these are the factors which could result into a company getting into the bucket of turnaround. And these are the companies which had an established track record and now have a potential to again show us sharp, growth once the fundamentals starts improving as we go further. And that's exactly what I meant that turnaround is all about. Short-term business disruptions for the reasons beyond your control. But as we go ahead, we start noticing that the event is seeing a turnaround. And because of the improvement in the fundamentals, we feel that the massive value creation or a re-rating is going to happen. Now, this is all about the Phoenix life cycle. The portfolio or the stocks which are a part of the Phoenix, are going to follow this exactly the life cycle as it has been shown. And we are looking at those stocks where we feel that the cycle of disruption has been witnessed and the value creation or a re-rating becomes a natural phenomenon. Now, if I see what could the 3 stages for any company to go through this entire turnaround, obviously, either turnaround is about to occur, that you have been able to find a company where you can see that, yes, like a Maharashtra Seamless, which is a part of our portfolio, we were a little ahead of curve in terms of having the stock in the portfolio. And later on, we realized that even promoters started buying, at a cost which were little a bit, which was way above us. So we were like be in the stock little ahead of just when the turnaround events were about to occur. Like an event has already occurred, and now we are in a position to see a lot of positive implications on the businesses. It could be like Coal India is a classic case to talk about it, where we know the very fact that a special situation, which is because of the transparencies that has come in the e-auction, through the e-auction mode and all. Yes, the turnaround event has occurred, and now the realizations are getting captured in the form of PAT growth and eventually resulting into ROEs expansions and all. Or it could be after the turnaround event has happened, some strong visibilities on the earnings that you are able to witness, and hence you feel that this could be a target investment zone, like a Bharti could be a classic case. We have seen all the clouds around the company, or rather around the sector per se, and then this being the leader in the sector around the company, which was through an AGR issue. It could be the hostile approach of a Jio on the price wars. All are getting settled. Now they're talking about deleveraging the balance sheets. They're talking about a NASDAQ listing. They're talking about ARPU getting beyond 200 and heading back to 300 kind of a number. So, so all of these are the classic cases where we feel that the visibilities are getting better as we go forward. And all of them together results into a massive value creation, which is what the objective of the portfolio, which is a part of this Phoenix fund. Now, as I was mentioning, that turnaround cycles could be because of whatever reason. It could be internal factors, it could be external factors. Internal factors can be, there is a change in management, there is a change in ownership, business gets restructured because the management feels that certain businesses aren't a part of their core, and hence they can look at hiving them off. It could be the new product introduction or a new market where they are venturing into, and or it could be that you are looking at a far more optimal allocations of the capital. These are all internal factors which can lead to a turnaround event. But there could be multiple external factors, like an industry dynamics are completely changing. As I was mentioning about the telecom sector, the dynamics of the industries are changing with a lot of clarity now coming in. Or it could be because of the government's own approach of making the changes on the regulatory nature. Or it could be a lot of mergers, acquisitions, joint ventures. So these are the external factors which also influences the company becoming a target turnaround candidate. So these are internal and an external, two of them together leads to a turnaround event. And that's where we are looking at it. Now, what does that do? All these turnaround events results into, as quite naturally, I'm sure that doesn't need too much of an explanation, that an accelerated earnings growth could lead to an improved margins, longevity on earnings visibility, and healthier balance sheets. So, so that's basically what we mean is that, whichever way I look at it, the balance sheets are getting stronger, the financials visibilities are becoming far and more better, and that's a typical turnaround cycle, the way one will look at it. Now, this is, on this slide, if you could see, this speaks nothing, but it's basically the framework of our entire investment thesis. So if I just spend a minute on this for you all to understand how do we really work. If I go back and look at the 35, 40 odd years, even if I look at a profitability at a company's level or an ROEs at a indices, we have seen the 15 being the magical number where most of these things are getting converged, and hence we looked at 15 as a number. On an x-axis, we looked at ROEs, return on equity, and a y-axis been PAT, and we divided this entire matrix into 4 quadrants. The extreme right quadrant, which is secular, is nothing but talking about looking at those companies which have demonstrated in last 15 odd years both ROE and PAT in excess of 15%. And as a house, seculars are our core portfolio. We always remain overweight on secular, and these are like all your consumption-oriented businesses like banks, insurance, retail. And as a house, we always remain overweight on secular. But what we do, we always remain underweight on value traps. Now, value traps are generally the businesses which have seen a tepid PAT or a tepid ROEs, and they are largely the PSUs or the regulated businesses where even if you have some handsome profit getting made, government will intervene, take the money out, but they will never let the money stay in the balance sheet. And we do not normally like these kind of businesses. We feel that they have their small patches, but eventually they struggle. And hence, we as a house remain always underweight on value traps. Now, other 2 parts, cyclicals and a defensive. Cyclicals now normally are the businesses which are largely capital intensive businesses. These are the businesses which shows a better profitability, but a very, very timid ROEs and all, and just opposite to our defensive, which doesn't need too much of capital allocation, like IT services, medias, and the worlds of those. We tactically keep shifting between cyclicals and defensives. So our core is very clear. Secular is our core. Value traps are the restricted allocation. We don't look at it, and cyclical and defensive, we keep doing a tactical changes. That's the framework that we normally follow. But Phoenix is an exception to this framework. Phoenix is a portfolio where, other than our natural or normal phenomenon of being overweight on secular and underweight on value trap, we actually have taken just the opposite call. We are overweight on value traps and underweight on secular. Now, when I say overweight on value traps, not necessarily all the companies need to be the part of PSUs or utilities, because I'm talking about ROEs getting compressed and a PAT getting compressed, automatically you will fall under value trap. So we have a Cyient as one of the stocks in the company, or we have a Alembic Pharma, but these are not the businesses where I can say that they are either PSU or telecom or utilities. But by virtue of the cycle that they have been through in last 2 odd years, they have seen a massive compression in a PAT, resulting into an ROE also getting compressed, and hence they become a natural stocks for us to look at it. Now, if you go back, what did I say? I think when you do not know which way the markets are going to go, are the markets expensive, are the markets cheap? I think the best way to look at the portfolio where you see the drawdown risks being minimal. Now, if I'm looking at a value traps being a dominant part of the portfolio, then one thing I'm also mentioning very clearly, that these are the stocks which haven't performed very well for the reasons well established till now that you would have heard me and would have understood why these companies haven't done very well, because they had gone through a massive challenging time in their recent past. Though the fact remains they have an excellent past, but the recent past had been pretty challenging for them. And we feel as we go ahead, the times ahead for them are very, very exciting. Now, these are nothing but a stock selection criteria. Any stock which become a part of the portfolio has to undergo these 7 criteria. Yes, as I mentioned, everything has to move up the curve. So idea is whatever we take in the portfolio is eventually converge becoming a secular. And that's the reason we said upgrade in a quadrant on SCDV is a very, very important phenomenon. Lower profitability versus historical trends doesn't need an explanation, as I was mentioning. Third point is very important, proven track record. But the companies need to show a track record of at least 6 to 7 years out of the last 10 to 15 years of ROE demonstration in excess of 15%. So I'm not going to look at a garbage in, garbage out kind of a thing, even if they are a perfect candidate of a turnaround. But we are going to look at the companies who had demonstrated an ROE in excess of 15% in the past, but for some reasons aren't been able to do in the recent past. They need to trade at a discount to the historical valuations. The changes in management or ownership could be the reason. The point number 6 again is something which is part of our DNA. The forensics and the strong governance is something that at a balance sheet level or at a promoter level is something which is non-negotiable for us. And obviously stocks have to show the price correction from what the historical trends had been. So if the stocks are meeting these 7 criteria, they become a natural candidate to be a part of the Phoenix portfolio. Now, there are multiple cases. I don't want to spend time on them, but straight away I come to the portfolio and probably spend a minute over here. So what you can see, let's look at the right side top quadrant. I'm talking about segment breakup, and you can already see the value traps are close to 30%. Now, this is exactly what I meant. So we are pretty close to the benchmark. Normally, you will see we being not more than 6-7% of the benchmark for a value trap, but here we are pretty much equivated. But look at the seculars. Against a benchmark of 22, we are just 88%. And that's exactly the point that I was making, that knowingly we have built a portfolio where we would want to look at turnaround stories. For turnaround stories, you have to look at something in value traps or something in cyclicals, which again is showing dominant allocations vis-a-vis the benchmark. But let me use a disclaimer that all of these segment breakups that you could see at a portfolio level is not an outcome of managing the numbers, but it's basically an outcome of picking the stocks. So we are in the business of picking the stocks, and eventually they all result into their allocations. But by virtue of the thesis of the portfolio, the way the portfolio needs to get constructed, automatically the outcome is desirable the way it ideally should have been. On a market cap basis also, if you would have seen, it's a pretty much 50-50 large and a non-large. And if I'm talking about turnaround stories and all of that, obviously I will have to move beyond the domain of a large cap, and which is the reason it's showing like this. And that's where another point that I would want to make in. Today, if you go to a client and tell a client like, look, I have a great fund, and why don't you take it in your portfolio? The very first question the client would ask is, why? Because I already have a 5 portfolio, why should I take the 6th one? The answer to this why is the uniqueness. The Phoenix portfolio, if you would go and have a look at the entire portfolio and do a common checks, the commonality factor is not more than 20%. Now, because of this commonality factor not being 20%, this shows a lot of uniqueness, and hence the client who gets offered this portfolio also accept it very graciously, because he knows that he is also onboarding some new ideas which aren't a part of his portfolio if you go and look back. And that's where another uniqueness which comes for this Phoenix fund, which is the common factor. If I look at this portfolio vis-a-vis most of the portfolio in the market, that commonality is not more than 20-25%. Now, this is a very, very strong slide which will help you understand why a fund like this makes a lot of sense. Let's look at the last row, which talks about EPS growth. I'm talking about 21% EPS vis-a-vis a 15%, a strong arbitrage of 6% The command that turnaround fund is having over the indices is yet priced at 2, where the indices are at 2.6. So basically a better growth, not yet priced in. Can this be a good reason for one to look at it? If I am telling you that, look, I can grow the portfolio 21%, but you haven't yet priced me in, I think that becomes a strong reason for one to say that, look, this is a great portfolio for one to look at it. And hence we feel another very strong reason for one to look at the Phoenix fund. Our top 10 holdings, what it is, maybe few of you would say that, a couple of names that I can see on the tops are a very, very common name, but to me, names does matter. Yeah, fair. But what matter more is at what point of time have you onboarded those names? I think to me, I think that's equally a critical thing for one to consider. For example, when we took ICICI or an Axis, we haven't taken them post Mr. Bakshi or Mr. Amitabh moving in. And which ideally become a candidate, the stocks become a candidate because, as I mentioned, management change is also one of the criteria. But actually, we onboarded both the banks much ahead of time because we started loving or liking the change of orientation of a bank from a wholesale oriented to the retail oriented. And that's the trigger which started making us excited, and we started onboarding. And the other stocks that you can see, Maharashtra similar result had recently come. Fantastic result. They have onboarded the new products. They have started getting into the offshore market. They still work at a 70% capacity, strong operating leverage as a case for one to talk about it. I think Blue Dart, as you can see, is something that we have already started pruning. much of the position we have already pruned, some is still left in the portfolio. It has delivered exceedingly well for us. The one thing that we also do when we look at the portfolios, we basically follow the same trend line as I was mentioning to you at the beginning. Yeah, this one. So basically, idea is to look at the stocks which are closer to 1 standard deviation minus negative, and as they start moving from -1 standard deviation to the average is the time when you start accumulating, and after average to the +1 standard deviation is the time when you would start offloading the stock. So this is something which Anup and the team, besides the framework, which obviously helps them decide on what stocks to onboard and what not to. It's also a nice style of a price to book valuation metrics that they also consider in terms of looking at the exit strategies at a stock level. These are top 10 holdings that we have in the portfolio. The fund has done exceedingly well, especially last 6 odd months. If you can see, it has really performed well. As I said, these kind of strategies are not the strategies one can think of in a 10,000, 20,000 crore strategies. Right. These strategies have the finite sizes, and with the finite sizes, it makes sense. When the funds are smaller. So the size of the fund is close to 1,000 odd crores, not even 1,600 crores. So that also makes the fund a very optimal sized fund for one to consider. That's from my side, Aditya.
Yeah, sorry, I was just barging in. So we are a bit out of time. If you'd like to quickly sum it up in a minute or so, because our other speakers are already waiting.
No, I think I just summed it up, Aditya.
Okay.
I think pretty much I said that, I think A, the uniqueness of the portfolio, B, the turnaround story, and C, the size. I think to me, these are the 3 factors which are very, very compelling for one to look at and consider.
Correct. No, great. So thank you so much, Anunay, for joining in, and we wish you all the best for your IIFL Phoenix portfolio. Audience, please feel free to reach out to the IIFL Asset Management team if you're interested in distributing or investing in this product. Anunay, thank you so much for your time and joining us for this inaugural edition. I'll quickly jump into the next session. I think both our next speakers for the next 2 sessions are already waiting here. Aditya, I think, are you here?
Yeah, hi.
Hi. So thank you for joining in, and apologies for making you wait.
No worries.
Yeah. The format. We'll have to slightly crunch the sessions in interest of the sessions that are coming next. So my request to you, Rakshit and Alok, will be to keep it short to between 15 to 70 minutes and focus more on the product if possible. So audience, our next speaker is Mr. Aditya Khemka. He's the portfolio manager with Incred Financial Services. Aditya has over 15 years of rich experience in healthcare business and investments across the world, including US, EU, and Latin America, other than India. So he actually has worked with Nomura earlier, and he's also been a fund manager with DSP Mutual Funds. Under his leadership, the DSP Healthcare Fund generated a massive return of over 65% in just over 12 months. I wish I had invested in the fund that time, Aditya. Nevertheless, better late than never. But thank you for joining in, and I believe you're here to talk about the healthcare portfolio.
That's right. Could you enable screen sharing for me?
I'll do that right away. So I'm keeping the introduction short so that we can spend more time.
No worries.
On this thing, but we look forward to engage more with all of you guys, speakers, in better, on more online and offline sessions. So Aditya, over to you.
Sure. Thank you. Thanks for the introduction. And I'll just jump right into it, given the time constraint. I hope the screen is visible, right? Okay.
Yeah, it is.
Awesome. So this is my background. I think, the host has done a great job of introducing me, so I'm not going to spend time on the background. This is the product I used to manage. I launched the product in November of 2018 at my previous organization. The product did phenomenally well. And, we were very, very fortunate to be a part of that journey. In September of 2020, I left DSP Mutual Fund to join IncRed PMS. And the job here at IncRed is to manage the IncRed Healthcare Fund. So let's talk about the IncRed Healthcare Fund. And let's first talk about the healthcare sector. How do we look at that? And then let's talk about the fund as to, what the fund represents as an opportunity, both for distributors and for potential clients out in the audience today. So how do we look at the healthcare sector? We broadly divide the healthcare sector into 5 buckets. So one thing I want to message very, very clearly in this presentation, as I speak, you'll realize healthcare within itself is a very, very broad bucket for investing. So even though a healthcare fund may be a thematic fund in the sense that the underlying consumption theme is healthcare, but each of the business models within healthcare are extremely diversified and non-correlated. And therefore, the product itself is actually a diversified product. And there is more than enough data out there which substantiates what I say, but due to paucity of time, I'm not going to take you through the data, but the conclusions of the data. Okay, so the first bucket in the healthcare sector is the unbranded generic bucket. Now, in unbranded generics, essentially, these are pharma companies in India which sell generic products to export markets of US and Western Europe. Now, the US and Western European markets, by and large, have a regulatory framework where if you're selling a generic, you're not allowed to brand the product. So that means you will be selling paracetamol by the name of paracetamol or ranitidine by the name of ranitidine. You cannot call it Rantac or Crocin or whatever you wanted to call it. Because of which what happens in the end markets place, when the patient goes to the pharmacy to buy ranitidine or paracetamol, he says, give me ranitidine, give me paracetamol. The pharmacist has to tell him that he has 7-8 different paracetamols or ranitidine, and which one would the patient buy? And the patient more often than not will buy the lowest priced paracetamol or the lowest priced ranitidine. So therefore, as a company which is selling these products to these markets where it's completely commoditized, there is no differentiation between company A and company B's product. And therefore, what sells the product is the price. So as you can imagine, it is a commodity business model where it's a push business. So you have to push your product to the wholesaler, push your product to the retailer, push your product to the consumer. And you have to make margins that are left over after the pricing competition between you and your closest competitors. So it's a very difficult to do business. The business has been under intense pricing pressure over the past 7 to 8 years. Regulatory issues, US FDA issues in the sector are very common. We keep hearing about US FDA problems with many, many different entities. And then the return on equity on this business is very, very low. Simply because in this business, pharma companies act as manufacturers, and you have to keep your costs low because you have to keep your price low. You have to keep your costs low. So you're vertically integrated. You have a lot of, supply chain management and all that, so which creates a very asset intensive environment. And therefore the ROE is just not good enough because you're keeping low pricing, making low margins, and your asset base is very high. So the ROE is generally very, very suppressed. And it has been the case over the past 7 to 8 years. But this is the bucket, which is the largest bucket within healthcare. It is like 45-50% weight in the BSE Healthcare Index, which is a healthcare index. So what we like about the unbranded generic space is that there are certain stocks in the space which have actually come to valuations from where we see absolutely no downside. We just see upside. I mean, these stocks can be potential multi-baggers in 2 to 4 years if conditions were to improve for this segment. But then there are other stocks within this in this bucket where the business is already doing okay, average, and therefore those stocks don't really give you a very good opportunity to invest. So we have only 2 names in the bucket, and that's about 10% of our portfolio allocation. The allocation in the index is about 45%. So we are way away from the index in this bucket, way underweight. The branded generic bucket. So in this business, basically, is the branded business that we see in India. So pharma companies sell brands. They sell Crocin, they sell Calpol, they sell Rantac. So here, when the patient goes to the pharmacy, he doesn't say, give me paracetamol. He says, give me Crocin. Now, if you look at all of your own individual behaviors, none of us would have ever asked the pharmacist, what is the price of Crocin, right? We just go and say, give me Crocin, and how much do I have to pay, right? So this is a pull business. Here, the brand of the product makes the patient and the doctor pull the brand off the shelf, and therefore the bargaining power in the supply chain lies in the hand of the owner of the brand, which is the pharma company. So in this business, the majority of the pharma companies actually behave like FMCG companies. A lot of the products that they sell in the market, they actually don't even manufacture. I'll repeat, a lot of the products that they sell in the market, they don't even manufacture. They just brand the product and they promote the brand. So they behave like an HUL or a Nestle or a P&G rather than behaving like a Sun Pharma or Dr. Reddy's when they are doing this business in India. And that is why this is a high growth, high ROE, highly cash generating business. And the valuations in this segment, ironically, are more reasonable than the valuations in the unbranded space. So therefore, we actually absolutely adore this segment for the secularity of the cash flow, for the valuation, for the margin of safety, and for the asset-light balance sheet that these companies have. So they're essentially recession-proof. And they have a lot of pricing power because we are in an environment where there is inflation and these guys have brands. So brands don't care about the cost pressures. They will just pass it on to consumers. So branded generics we are extremely bullish on. The healthcare index has about 22% weight in branded generics. The healthcare PMS that I run has 45% weight. So we are double the weight of the index in this bucket. The third bucket that we classify in healthcare is the API manufacturing, or in layman terms, the raw material for pharma manufacturing business. Now, this business has some historical context. Earlier, India used to be the dominant API player in the world back in 1980s. Then China came with no pollution control, and they became the leaders in the API space. Even India started buying from China. But now the cost for China has also gone up. Now, from a cost standpoint, China, India are more or less at parity as regards to most of the molecules. So many of Chinese customers who were earlier buying only from China are now buying from India as well. So here what has happened is it's a turnaround story where companies which are almost gone sick are now suddenly doing capacity expansion because their order book has suddenly blown up. And the reason the customers are migrating away from China are multiple. There is a geopolitical reason, there is a cost pressure reason, there is an inconsistent supply reason, there is an intellectual property challenge reason, there are multiple reasons. But the net effect is that those customers want to add one more vendor, which is not Chinese, to their product portfolio. And that is where India comes in. So China today sells $40 billion worth of APIs, exports. India exports only $4 billion. So we are 1/10 the size. If China loses, 10-20% market share, the revenue for Indian companies can double or treble. So that is where you see, the opportunity for Indian API companies. So essentially, whatever has happened over the past 5 to 7 years in the Indian chemical universe is what we envisage will happen over the next 5 to 7 years in the Indian API universe. And the fun fact is that a majority of these stocks are still extremely reasonably valued, even compared to their own history and even compared to chemical stocks. So, it's a very interesting space. The weight of this space in the index is about 15-16%. In our portfolio is about 20-21%. So we are overweight this space. We like it. The fourth bucket is hospitals. Now, hospitals are essentially retail stores, but branded retail stores. So, in India, earlier hospitals were more fascinated by owning the land and building in which the hospital stood, which made the business very asset heavy. And therefore, ROEs were always low despite healthy margins. Over the last decade, majority of the hospitals that have come up from the organized players are actually asset light, where they lease the land and building and not own it, which reduces EBITDA margin because now you have to pay lease rentals, but that increases ROE because your asset base is very, very small. 70% of the capex of a hospital, if you own the land and building, is land and building. So if you're not owning the land and building, in 30% capex, you can open a new hospital, right? So now these hospital chains have started opening asset light hospitals, which has improved the ROE and margins. And therefore, we like the hospital business for that. It's a secular branded business, negative working capital, which should talk to you about the bargaining power of the business. So hospitals in the index is about 12-13% weight. In our portfolio, it's about 19-20% weight. So we like hospitals. Diagnostics, 85% of the diagnostic market is mom and pop stores, unregulated, unorganized market, and 15% of the market is organized retail chains like your Dr. Lal, SRL, Metropolis, etc. So we like the diagnostic business from a standpoint of unorganized to organized, something that we're seeing in many other subsectors in our economy. I think that is also happening in diagnostics. Yes, there are certain, new low pricing guys who have come into the market and they're trying to disrupt the market. But look, these are very, very early days. Even if there were to be a disruption, it will take 10-20 years, like it took Thyrocare, because Thyrocare was an original disruptor when they reduced thyroid prices. So it took Thyrocare 20 years to gain scale. So these new disruptors, although they've come to the market, they are trying their best. I don't foresee anything less than 10 to 20 years for them to, show any material disruption. So we have a lot of time for the incumbents still to gain footprint and grow and improve their ROEs. So which is why we like the diagnostic space still. Now, if you focus on what I'm trying to talk about, I'm trying to talk about diagnostics, hospitals, API manufacturing in India, and branded generics in India. it's all India, India, India. I'm saying we don't only need to invest in exports in the pharma segment or the healthcare segment. Our internal economy is very, very buoyant. Over the last 10 years, 2011 to 2021, India GDP CAGR was 5%. India healthcare market CAGR was 7.5%. Despite which today, while India's GDP per capita is $2,000, we are spending only 3.5% of that $2,000 on healthcare. Now, any other country in the world which has more than $2,000 per capita GDP doesn't spend anything less than 5% on healthcare. Which is, what does it mean? Over the next 10 years, if India's GDP were to grow at 8% CAGR, the Indian healthcare market will probably grow 12 to 14% CAGR, will grow higher than the GDP, which we have done already for the past decade, but we'll continue to do that over the next decade, because a decade back, we were 2.5% of GDP. Today, we are 3.5%. A decade later, we can be 4.5%, 5%, 6%. So, how much we achieve, we'll see, depends on a lot of things, including demography. But we feel that, a lot of these things will help the companies grow faster, because the market itself will grow faster. Just a data point on the US side. So in 1950, US used to spend 3% of GDP on healthcare, 28% of GDP on food and beverage, 10% of GDP on clothing. In 2010, those numbers are 13% on food and beverage, down from 28 to 13, 3% on clothing, down from 10 to 3, but 16% on healthcare, up from 3% to 16%. So what this tells you is, as the disposable income of an economy grows, the healthcare expenditure grows exponentially, and which is where our entire focus is on India, because we feel we are on the cusp of becoming a superpower. We are on the cusp of gaining more and more GDP. And when we do, the incremental expense is not going to go in clothing or food and beverage or QSRs. It will actually go into healthcare. Why invest now? So I hope I have sort of educated you on what we feel is the reason to invest in healthcare, but why now? So if you look at the 10-year history, we are trading almost at the 10-year average in terms of EV/EBITDA. But remember, EV/EBITDA has EBITDA as the denominator. So if the current profitability is in steady state, this ratio makes sense. But my point is, in the current scenario, the EBITDA of healthcare is actually suppressed, because we have seen cost inflation, but our prices have increased later. There's always a lag between the cost inflation and the price pass on. So the EBITDA that you currently notice in the healthcare segment is actually suppressed. So EV/EBITDA is not therefore a good indicator. The best indicator is price to book, because this is accumulated profits. The book value is accumulated profits, which has seen across cycles, low EBITDA, high EBITDA, stable EBITDA. So if you look at price to book, we are substantially below our 10-year average. If you look at return on equity, we are substantially below our 10-year average. So the best time to invest in any stock or any sector or any market is when the profit and the multiple both are below average. So eventually, when the business normalizes, the ROE will go back to average and hopefully go above the average. And then the multiples will also follow. They will go up at the average and then above the average, which is why as an investor, it's a double bonanza for you. You get re-rating and you get earnings growth, you get ROE improvement. So which is why we are extremely optimistic about the portfolio over the next 5 to 10 years. This is the weight of healthcare in broader indices, again, below average compared to the last 10 years. Now, as I said in the beginning, healthcare itself is a diversified bucket. So our product, we don't call it a thematic, we call it a diversified healthcare product. So the diversified healthcare product, hospitals represent branded apparel retail companies, kind of a model, business model. The index has 12, the competing funds, the mutual funds that you have an option to invest in have 14%, we have 16% in hospitals. Diagnostics, 2%, we have 5%. Generics 44, 46, we have 11, so substantially lower than the generics in the index or the mutual fund. API 8% in the funds, 16% index, we have 20, and branded generics, the FMCG type business, we are the competing funds are at 22, index is at 21, we are at 45. So you can see our bend towards secularity, asset light, ROE, cash flow rich businesses. Now, if you had invested 100 rupees in Nifty 50 10 years back, today you would have 300 rupees, which is the blue line that you see here. Had you invested the same 100 rupees 10 years back into the healthcare index, you would have had about 400 rupees, which is the orange line here. But the healthcare index has that 45% unbranded business, which we don't really like. So we bifurcate the healthcare 400 rupees into two parts, into the unbranded businesses and everything else, which includes diagnostic, hospital, branded, generic, API, and all of that. So had you invested 100 rupees into only the unbranded businesses, over 10 years, it would have become 250 rupees. So less than the Nifty 50 returns. But had you invested 100 rupees in every other business, excluding unbranded generics within healthcare, your 100 rupees would have become more than 500 rupees. So 90% of our portfolio is on this curve, whereas only 40% of the index is on this curve, and only for 50% to 60% of our competitors' portfolio are on this curve. So you can see where we are, leaning. We are leaning towards a more secular wealth creator, towards a higher alpha creator, rather than staying with the bigger, more popular names, because we aren't looking for stability, or we aren't looking for low standard deviation of NAV for our investors. We are targeting higher returns over an invested period of time. So as you can see, today everybody's scared about inflation, and they wonder what inflation can have as an impact on your investments and equities. Let me inform you, over the last 20 years of capital history of the capital markets in India, healthcare has performed top quartile whenever inflation has been more than 5%. So whenever inflation is more than 7%, health is second best performer within all the several sectors that you can invest in. And whenever inflation is between 5 and 7, we are again top quartile performers. It's only when the inflation is in the sweet spot of 3 to 5%, that is when your cyclicals do better than healthcare. Healthcare, mind you, still gives you positive returns, but it underperforms other sectors. So in that regard, if you feel that coming 5 years, 10 years, we are going to see turbulence on the inflation side, you must have a healthcare exposure. You must, other than your diversified portfolio, because your diversified portfolio gives you only 3 or 4% healthcare. That is what the index in the broader index is. That is what the weight in the broader index is. So they will give you only 3-4% exposure. You must have a additional 10-15% exposure on healthcare if you feel inflation is going to remain high for the next few years. So I'll summarize and end with this. This is our portfolio returns over we have been just live since February 21, so we don't have very long-term data. It's only about a year and a half data. And it's a 20 stock portfolio, concentrated portfolio. Obviously, because most of the large companies are unbranded in nature, we have very less large caps. We have more small and mid caps, because all your API companies, your branded generic companies, your hospital diagnostics, they all fall within mid and small caps. And it's a 20 stock portfolio. These are the top 10 holdings that we have. And this has been the performance so far. So we are neck to neck with the index, but slightly better than the index after fees and taxes since inception. And yeah, so that's how the portfolio has evolved. So that's it from me. I thank you guys for listening patiently. Hope I didn't go too fast, and hope I was comprehensible. And if there are any questions or queries, just shout out.
That was an excellent masterclass. I would say a mini masterclass, Aditya, on the healthcare investing opportunities. It was fantastic to listen to you, and I'm sure early days for InCred, you had an InCred in this, but I'm sure this they're very, very great times ahead for all of you. So audience, we honestly do not have time. I think I'll have to request all of you to touch base with Aditya and InCred team separately on LinkedIn. We are running late, almost 20 minutes. So Aditya, thank you so much for the time. And as I said, wish you all the best. And I hope audience also learned a lot from this. I did, got to know some very exciting new things from you. Look forward to engage with you more on more such knowledge sessions.
Thanks, guys.
Thank you.
Thanks.
Thank you. Have a good day. Bye. So quickly moving on to our next session by Rakshit Ranjan, co-founder, Marcellus Investment Managers. Rakshit, hi, good evening. Welcome.
Hi, good evening, everyone. Good evening.
Rakshit, do you have any presentation that you'd like to share?
I can share slides.
Yeah,
yes, please.
1 minute. All right, so you are the co-host now.
Thank you.
Audience, Rakshit doesn't need an introduction. He is the co-founder of Marcellus Investment Managers. He is going to talk today about the consistent compounder PMS. Talking about Rakshit, he's spent around 6 years covering UK equities with Lloyds Bank as director, institutional equity research, and Execution Noble as sector lead analyst. Since 2011, Rakshit led Ambit Capital's consumer research franchisee, which got voted as #1 for discretionary consumer and within top 3 for consumer staples in 2015 and 2016. He launched Ambit's Coffee Can PMS in March 2017 and managed it till 2018. Under his management, Ambit's Coffee Can PMS was one of India's top performing equity products during 2018. By qualification, he is a BTech from IIT Delhi and is a CFA charter holder. So Rakshit, wonderful to have you with us, and looking forward to your session. We have around 15 minutes for this, And as I'm so we, the audience has joined us through a separate virtual event platform. And if we have time towards then, I'll be happy to take questions. Otherwise, we can just get done with your sessions and the audience can reach out to you separately, even Marcellus. So over to you.
Sure, thank you. Thanks to Equalify team, particularly for hosting us. Good evening, everyone. Very quick introduction about Marcellus. So the firm was founded about 4 years ago. And prior to setting up Marcellus, most of the members of the founding team had been working together for the best part of the last 2 decades. So particularly Saurabh, Pramod, and I have been working together since 2004, and that's one of the bigger strengths of the team here. We've ended up learning and loving what we do by working together over these 2 decades. Today we are managing around $1.7 billion in assets under our care in a PMS avatar. The largest of the 4 strategies that we manage those assets across is called Consistent Compounders, which is the fund that I manage. The most relevant sort of underlying foundation or thematic of our investment approach is that India, we realized 5-6 years ago, India is going through a massive inflection point, which gives a very interesting arbitrage to long-term investors. And the inflection point is that, as the chart on the right shows you, the country is getting polarized. 2 decades ago, India was a combination of several small economies. There would be regional players, niche players. Very few industries would be dominated by pan-India players. Whereas today, most industries the profit pie is controlled by 1 or 2 companies altogether. And the chart on the right shows you that across the entire economy, top 20 corporates, they contribute to more than 60-70% of the entire corporate profitability of the country. The reasons for this polarization are easy to comprehend. To begin with, the country got networked together in terms of infrastructure, so road, railways, aircrafts, etc. But more importantly, in the last 5-6 years, technology and a series of events such as demonetization, GST, and now COVID, they've accelerated the polarization. Now, India is not the only country to have gone through polarization, but India is unique in the sense that whilst other large developed nations which have been polarized are they are rich and they are small. Being rich means there are very few inefficiencies that a great company can benefit from, whereas in India being poor means there are lots of inefficiencies that every industry offers for a high quality corporate to exploit. In India, we also are a large economy, which means that the cash that gets generated by dominating through exploiting a few inefficiencies in every industry, the cash that gets generated, it can be redeployed to deliver growth, right? So it's a combination of high cash generation and high growth by playing through polarization. And we call this an arbitrage because when you're investing in established companies which have a long historical track record, you are not speculating enough. You're not sort of trying to time turnarounds. You're not trying to time macro entry exits. You're not trying to pick up companies which never had any history and might have a great future. You're piggybacking on companies which have had a history, and some of those might also continue to have a great future, and that reduces the risk, the fundamental risk inherent in the investment approach. Now, how do we build the portfolio? So there are a set of filters, and then there's a lot of bottom-up research. The first filter that we do, and this is a big risk mitigating filter, is around accounting fraud detection. We're very paranoid about this. For the last 10 odd years, the team at Marcellus has had its own proprietary fraud detection framework, which we keep polishing and sharpening every year as new information comes in. A quick snapshot of the kind of ratios we use to detect fraud is in the table on the top right. Typically, there are 2 types of frauds that we're trying to eliminate here. One is the sort of more sensational fraud, which is underlying business might be completely hollow, but the promoter or the management might have overstated fundamentals. When this sort of a fraud gets detected, it hits the front page of the newspaper. This is like the Yes Bank, the DHFL, etc. Types of examples. But unfortunately, the bigger issue of fraud, of accounting fraud in Indian equities, is the second type of fraud, where the underlying business might be actually very great, very good, very cash generative, but the management and promoters, they have understated the accounts, and that's because of pilferage, siphoning out of money. What this results in is that it doesn't hit the front page of the newspaper, the stock price doesn't crash, it just doesn't compound for you, despite you having identified a high quality business. And hence, the need to identify and eliminate any red flags in accounting practices of the businesses that you invest in is actually paramount in our view. Our most recent book on our philosophy, called Diamonds in the Dust, actually is red meat. You will get a very long list of live case studies and old case studies to understand about how accounting fraud detection is carried out at Marcellus and why it is important in delivering returns. So that's the first filter. What comes out of the first filter is then put through the second set of filter, which is historical capital allocation track record for longer than 10 years should be consistent and healthy. If it is not, then this is where speculation begins in an investment process. We don't want to invest in companies where history either was bad or non-existent or volatile and future might be good. We actually want to invest in companies where history can teach us more about the DNA of the organization, more about the approach, the discipline towards capital allocation of the organization, and using that history, we can build our own assessment of whether the future is going to be great or not. So that's the reason we want revenue growth and returns on capital employed for longer than 10 years historically to be consistent. If it is not, then we don't include those companies in our coverage universe. What comes out of the first two filters is then put through a very rigorous bottom-up research process, and this is, broadly speaking, divided into two parts. The first part of the research is what you see in the on the left-hand side of this slide, which is we want to see our portfolio companies have a lot of pricing power. Now, this is conventional stuff which most investors try to do. The only extra layer of rigor that we add here is we don't define pricing power or competitive edge in the way the textbook defines it. Now, the textbook definition is ability to hike prices when raw material costs go up. We believe that's incomplete. The complete definition of pricing power should be that if you are investing in a company which is selling products at, let's say, 100 rupee price point to its customers, and then a competitor, a rival comes in and offers a 60 or 70 rupee price point for a similar type of a product to the same customer, then will your investee company be able to retain the customer without cutting down on the price? As in, the profitability should not get compromised along with protecting the market share. If that is not the case, if you are investing in a Unilever or a Maruti where every time a Colgate offers a buy one get one free, and a Unilever also has to match with a buy one get one free, otherwise Close Up and Pepsodent lose market share to Colgate. If you're invested in a Maruti where if Hyundai Accent offers 10% extra margin to the dealer, then Swift Desire also has to match. Otherwise, Swift Desire customers move to Hyundai Accent. If that's the kind of company you're invested in, it's low pricing power, despite being dominant. But if you're invested in companies such as, say, a Titan, an Asian Paints, Page Industries, where for a Titan, every jeweler tries to undercut Titan's making charges. For a Page Industries, Van Heusen launched a massive price war 2 years ago. For an Asian Paints, you see every 3 years a new large balance sheet entrant coming in trying to undercount on pricing. 2 years ago, 3 years ago, it was JSW Paints, and I'm sure a couple of years down the line it'll be Grasim. You don't see any impact on either market share or profitability of these companies. So that's the assessment of pricing power that we want to do in our portfolio. Why is it that these companies aren't shaken up by intense competition? The more important aspect of our research process is the right-hand half. That's the non-conventional stuff, and that's actually a lot more juicier. Biggest part of undervaluation of the companies that we invest in comes from here. It's about the sustainability of greatness into the future, right? Whilst it's relatively reasonably well known that the kind of companies that we invest in, the Asian Paints and Titans and Dr. Lal PathLabs of the world, they are They're good quality. They have high pricing power. Some investors certainly know that. Very few investors, and hence the broader market, appreciate the sustainability of this pricing power into the long-term future. And that's where we make bulk of the returns that we derive for our investors. Sustainability of greatness into the future, we assess via two approaches. One is tangible capital allocation decisions. So last 2, 3, 4 years should be able to convince us about how the existing core competence of a business will be deepened over the next 3 to 5 years. If it is supply chain for Asian Paints, that is its competitive edge. We want to know why in 2025 the supply chain of Asian Paints will be better than it is in 2022. So that's the first type of capital allocation decision. Tangibly, we want to see decisions being made in that direction in the more recent past. The second piece is we want to see our portfolio companies add new revenue growth drivers. Otherwise, if Asian Paints remains a paint company, if Titan remains just a jewelry company, if Jockey remains just an innerwear company, then growth runway becomes limited and competition has a risk of catching up. But if a jewelry company like Titan sort of diversifies into eyewear successfully, into sarees successfully, and diversifies the entire jewelry space through CaratLane or wedding jewelry beyond just being the old Tanishq, etc. If an Asian Paints gets into putty, into primers, into sort of waterproofing and services of home decor, etc., then that gives us the conviction that these companies are likely to at least experiment towards sustaining greatness over the longer term. And the third aspect is we want to see our portfolio companies disrupt their industries radically. If that doesn't happen, then it becomes very difficult to sustain greatness as the consumer habits evolve, as the external environment evolves. So that's the first part of assessing elements of sustainability of greatness, and we quantify many of these subjective aspects. One very big subjective aspect is a qualitative aspect, I would call it, is succession. It's the quality of the board, quality of the management team, and the quality of systems and processes at the ground level. If you don't do this, you will probably be invested in a company that is a Lalaji ki dukaan. It runs well today, but doesn't have the continuity and scalability of decision-making from the board and management team into the future. We need a decentralized decision-making at all of these levels so that it's not that the management is becoming a bottleneck, one person is becoming a bottleneck, and the entire quality, the entire greatness of the business is dependent on 1 or 2 people. This is probably the hardest part to, first of all, identify and then quantify. In our research process, we've got a framework to quantify all of these factors, and then there's an interplay of all these risks. Different funds at Marcellus have different combinations of those interplays, which defines the position sizing, the concentration of the portfolio, and absolute valuations of the stocks. So that's the approach. We have a 14 stock portfolio in consistent compounders. At any point of time, we'll have 12 to 15 stocks broadly in this portfolio. The churn in the portfolio is very low. These are the companies which are the non-financial companies. We've sold only 4 companies in the last 4+ years of managing this and bought only 5. So the churn is typically 1 stock a year. The outcome of the portfolio we expect is that all companies invested should compound free cash flows akin to what this chart on the left shows, the table on the left, where whether you look at the last 20 years or the 10 years or any 10 years or any 5 years, the rate at which free cash flows have compounded for these businesses has been stellar. It's at least 20 to 25%, and that then translates 1:1 into share price compounding for all of those years, also being at a similar rate. That's the expectation. We've done that in the last 5+ years and expect a similar outcome over the next, say, 5 to 10 years. Very quickly, what we are witnessing in the current environment after COVID, you can see this is Asian Paints' volume compounding over the last, say, 3 or 4 years for various quarters in the more recent past. These companies have massively benefited from the crisis that has just gone. The benefits are emanating from the kind of capital allocation decisions that they've taken, broadly categorizing into three parts. In the last 2 years, M&A activity as one of the ways to allocate capital has been abnormally high. This is not a portfolio that in normal times will grow inorganically. These are companies which have always grown organically. But you can see here, Pidilite acquired a stronger competitor, Araldite. Dr. Lal acquired a new geography player, Suburban. Asian Paints made acquisitions in a couple of new product category areas in home decor. HDFC Life and ICICI Lombard acquired their competitors. The M&A activity frequency and quantum has been abnormally high here in the last couple of years. Secondly, many of these companies have accelerated investments around technology. So whether it be automation of their supply chains, demand forecasting, robotics in their manufacturing, and this tech investment has already started yielding results. So Page has doubled its network of multi-brand outlets that it caters to, from 55,000 2 years ago to more than 115,000 today. Asian Paints, despite already being a more than 50% market share controller 2 years ago, has increased its dealer count from around 90,000 2 years ago to 150,000 now. And this expansion of the product portfolio, of the network footprint, can't be possible for large companies like these without enough tech investment. And that then leads to the third type of capital allocation decision that many of these companies have taken. They are transforming their entire industries from traditional businesses to new age. Rather than sort of trying to invest in fintech, Bajaj Finance is a much better proposition, where 2 years ago it was a lender, and today it is transitioning into a complete fintech player. Asian Paints 2 years ago was a complete product provider, and today it is transitioning into a services provider. And these disruptions is what gives us the confidence, the conviction about the sustainability of their free cash flow compounding over the next few years. Finally, what do we do if we don't churn the portfolio much? Every time there is volatility in share prices, we try to benefit from those dislocations. For instance, in the last 6 months, we've not changed anything in the list of stocks that we've held in the portfolio of consistent compounders. But when Dr. Lal PathLabs fell by around 40% due to some news around Tata 1mg, etc., we bought it by the bucket loads. And to buy more of Dr. Lal, we shaved off a couple of percentage points each from stocks which had actually run up. When Titan fell more recently, when there was news around customs duty hike from 7.5% to 12.5% on gold, Titan's share price fell and we bought it by the bucket loads again. 2 years ago, we did exactly this, which the table below shows you. Bajaj Finance had fallen during the COVID crash far more than the rest of the portfolio. And we shaved off from stocks such as Nestle and Abbott at that time to buy more of Bajaj Finance. And within 6 to 12 months, it yielded handsome results. This sort of an activity actually adds around 2.5% to our long-term compounding. Other than that, it's a pretty boring, very simple, but highly rewarding approach towards investing. So this is the performance in the longer run historically. When you look at the 3 years or 4 years, these performance charts, they don't include July as a month, which itself was a 14-15% growth in the portfolio NAV and outperformance of around 5-6% over the last 1 month. So when you include that, the numbers look even prettier over the longer term. Shorter term had been a little disappointing, but that had its own non-sustainable reasons, which are now reversing, as I mentioned. The returns in the last couple of months are pretty healthy in absolute and relative terms. So I'll stop here. I hope I haven't exceeded the 15-20 minutes timeline given. Thank you for listening, and back to you.
Thank you so much, Rakshit. Wonderful knowing about the consistent compounders PMS, and sure it'll keep achieving great new heights. So all the best to you and Marcellus team for that. We do not really have the time for Q&A, so I'll have to skip that today. But audience, I request you all to please reach out to Marcellus team if you want to know more about the product as an investor or as a distributor. So Rakshit, thank you so much. Look forward to engaging with you more.
Thanks.
Good day. Audience, quickly moving on to our last showcase session for the day. And then we have a very interesting masterclass lined up. So I'll request you not to go anywhere else. If you know, quickly grab your cup of tea or coffee, do that. We'll be starting our next showcase session right away, and then we have a masterclass on real estate. So coming to the last showcase session, we have with us Mr. Alok Sasmal. Welcome, Alok. Good evening.
Hi, good evening, Aditya.
Welcome, Soham. So we have a surprise entry in Soham here, who's I'm sure going to, I believe, is here to assist Alok. But Alok and Soham and both represent FinIQ. Alok is the head of sales for India business of FinIQ Consulting. FinIQ is one of the biggest global financial software companies headquartered out of Singapore, and they offer solutions to more than top 50 banks across the world. Alok, in his current role, is conceptualizing and delivering digitized solutions for large banks and wealth management firms in India. He's worked for 18 years into AIFs, mutual funds, and banking in different leadership roles with companies such as Indiabulls Group, ING Bank, SMC Group, and few others before getting into financial technology industry. He's a commerce graduate from Calcutta University and a MBF from IIF and EPFRIM from Indian Institute of Management. You will have to explain us this terms, Alok,
Sure.
after you're done with your showcase session. But talking about this session, this is a platform showcase session, unlike the other earlier sessions. So here we're going to talk about FinIQ as a platform and the terrific benefits it provides both to the AIFs in doing their own work, as well as connecting with the distributor community. So thank you, Alok, for joining in, and over to you. I'll request you to keep this session up to for 15 minutes because we're already running late. So Q&A, you can always share your contact details after the session, and audience can get in touch with you directly.
Sure,
yeah.
sure.
So over to you.
Yeah. Thanks, Aditya. Thank you, everyone, on the eQualify platform. So briefly, we have next 15 minutes. We'll try to do fast forward on trying to cover entire aspect of what we are trying to present today. So broadly, as Aditya already briefed, we are Singapore headquartered global financial technology company. We are into this space for last 20 years. We have been witness to the journey of private banking, wealth management across Asian region, across Asian market, as well as European market for last 20 years. We helped in the digital journey of product distribution from the private banking space, right from, as Aditya already mentioned, we work with top 50 to 65 group, 50 banking group globally. So all the names comes to your mind of the global leader, right from the UBS, Citi, in the Asian region, Bank of Singapore, Nomura, all we work together. So as a technology company, we act or provide platform, or we act as a bridge. We provide bridge to connect product issuer with the product distributor. So what has happened in Indian market in last 20 years? When I started my career, a mutual fund was perceived to be alternate investment product. So selling mutual fund or placing mutual fund in the part of the portfolio was equally tough. What we are discussing about the alternate investment fund. So the journey has become fabulous. From when I started, the AUM of the mutual fund industry was 1 lakh crore. Today it is 38 lakh crore roughly. So it has gone up almost 38 times. So I think we are at a very initial stage where we see this kind of similar kind of growth in the alternate investment space. I've been hearing all the earlier speakers. They came out with some of the wonderful strategies, some of the wonderful product, which has an outlier. So we feel now from mutual fund, investors are moving or diversifying as part of their portfolio to an outlier, where some of the portion of the capital have patience to stay invested for 5 to 7 years horizon. That money actually started moving from traditional investment or a traditional mutual fund investment to alternate investment space for two purposes. One is to better alpha or better portfolio diversification, and also for a social cause. I think today, as we speak, investment opportunity is not only limited to any geography, it is now global. And also the objective of investment is not only alpha generation. It is also to be a part of the economic development specific to any country. Like the concept of ESG started boiling down to the individual investors. It started with the institutional investors. Now, individual investors also approaching to allocate some portion of their money to ESG. So, since we have a very limited time, let me quickly, I think Aditya, you'll have to make me host so that I can share my slide, or anyone from Aditya's team. Okay, meanwhile, okay, meanwhile, let me just a second. Okay. So till that time, let me discuss about the framework. What has so we as a FinIQ, we also created similar kind of platform, which is we are trying to create in Indian market is AIF Connect. AIF Connect is nothing but a market architecture where we'll connect one side all the AIF issuer or the product asset management companies. On the other hand, we'll connect all the market distribution partner, be it a large bank or a mid-sized boutique wealth advisors or RIAs or distributors. Considering both the party agrees mutually to distribute each other's product. So this platform will have all the bells and whistles, mechanism, control panel, so that distributor and product issuer can speak to each other digitally, approve product distribution, and entire lifecycle management through the platform. So we are actually this kind of product issuer in the global space. Let me check whether we can share the platform. Okay, no worries. Let me explain. So what we did internationally also, there is a product called structured product. So we created a similar layer. On the one side, we connected with all the buy side and the sell side. So our platform helps to connect all the product issuers to issue, create demand generation, book building, and also product distribution. All the contract note generation to distribution of the product, fund transfer, everything done is being done digitally. And that product or that platform has become very popular. The name of the product platform is EQ Connect in Asian market. Similar, we have similarly launched another platform called Euro Connect in European market. And that platform together, it does a volume to the tune of $70 billion per annum. Wish to share the slides, I think. Okay, sorry, I can't share the slide today. Maybe today we'll just broadly discuss about the framework. My colleague Sohom will just touch upon quickly on the framework, how the architecture model would work. And maybe some other time we'll take you through how the platform would look like, or how the platform journey would look like rather.
Yeah, sure. I actually just got in touch with Aditya.
Yeah, Alok, one sec.
Great.
Yeah, you're the co-host now.
Okay, perfect. Okay. Is my slide visible?
Yeah, we can see this.
Okay, great. So let's do the quickly fast forward. So these are the area what I wanted to cover today. So the evolution started long back in the 1970s in US market, especially with the emergence of, as we all can connect today, what is Silicon Valley is, or rather was back in 1970s. So that time only the institutional player, especially the university fund or the pension fund, used to support risk capital to new ventures, especially on the technology space. Gradually, this has emerged during 2020. All the institutional investors, be it from Asian market or European market, started providing risk capital through a venture capital format. GP/LP was the very prominent. Even till today, larger part of the private equity capital comes from LPs, all the pension funds or sovereign wealth funds. Globally, they do invest a large part of this private capital to this space. The emergence of alternate investment fund structure in India in 2012 has helped to democratizing this opportunity toward the family offices, domestic saving through a structured distribution model. So there are 7 types of structured product or 7 types of alternate investment products available in the market. So as we can resonate today, we all are living in a platform structure, platform social economy. So where everything we buy today, we will find some other platform. So what platform actually does? Platform helps you to connect with all the best possible options available to you and make your investor journey or your journey as a consumer more enriching, right from whether you are buying a right product, right from the manufacturer. The intention of the manufacturer is to communicate all the feature of the product or the benefit of the product to the last mile. That platform helps to communicate seamlessly so that there is no error or erosion of the communication in the journey. So similarly, if you can correlate in our market, it is very important what the fund manager wanted to communicate in terms of the product strategy, in terms of the expectation or the tenure of the capital should be stayed invested in that particular product. It is very important to boils down from the fund managers to their own sales team to respective distributor and then the client. So most of the cases in my last 20 years career in the industry, what we have understood, the objective or essence of the product are very, very refined. But when it comes to the investor level, when they invest, there is a mismatch in terms of the expectation. So I could, since we have a limited time, so I'll quickly move into this. Is just an evolution. I think all of us are fairly aware of. There are 960 AIF today. So it is very important to for an investor or a distributor to understand all the product from a single platform. Platform helps to connect or get all the relevant information, and this platform also enable to do the transactions for investing into all these platform. So that's the broader architecture of the AIF platform. These are some of the recent regulations happened in alternate investment private equity space in India and US market. So what is interestingly happening is the migration. As I initially said, a lot of mutual fund investors are allocating some part of their patient money to this kind of alternate investment fund, which they can stay invested for a longer period. Same with the digital channel. A lot of has happened in the retail space, like on the equity space, Zerodha or Smallcase has done, but on the private equity or alternate investment space, there is no such platform. So FinIQ intends to provide this market architecture. So these are fairly the global banks we work with. I would request my colleague Soham to just briefly touch upon on the broader architecture of the ecosystem or the platform. Over to you, Soham.
Yeah, sure. Can you move to the next slide, please?
Yes.
Yeah. So FinIQ intends to cover the entire customer journey as well as the funds manager's journey for an AIF, right? So helping the fund manager manage the funds and deploy them in the right direction with all kinds of tools, analytics that he would need. Helping the operations team manage AIF operations most efficiently without having to add too many resources in an automated manner. And helping customers in their journey with the AIF, not only the initial onboarding, but also subsequent drawdowns, as well as the penultimate steps related to performance of the AIF and corporate actions on an ongoing basis. Can you move to the next slide? Yeah, so this is what our key offering is. So we have the AIF core system, which is something that the AIF uses internally for the fund manager and the operations team. Everything starting from creating the product, the portfolio, investment management, holdings, analytics, corporate actions, all of that happens there. Our system will connect with all the ecosystem participants. So be it your custodian, trustee, the fund accountant, the data providers, banks, all of them will be integrated with the FinIQ system. So that becomes your core system to do with everything that has to do with the AIF. Then we have the AIF channel, where we want to connect the AIF to as many distributors as possible. I think many in the audience would agree that for an AIF having thin teams, it's very difficult to tap a vast pool of distributors. So we plan to solve this where, we will have a pool of distributors that are already on the Connect platform, and any participating AIF can reach out to them very, very easily, help with marketing and content distribution, help in onboarding distributors, and help in sharing performance details, and help the distributors onboard customers seamlessly as well. Yeah, can we move to that? So these are the few challenges that we have seen in the AIF ecosystem. So one is there is a lack of resources to engage distributors effectively, opaque and analog customer onboarding journeys, and post-trade performance is not disseminated very easily. So these are the key problems that FinIQ is intending to solve. Again, like you can see, FinIQ is going to act like a bridge between AIFs and between private banks, wealth outfits, RIAs, IFAs, all of them, to enable this customer journey to proceed as smoothly as possible. Next slide. Yeah. In terms of what we will be able to cover, so we will be able to cover the entire journey for all three categories of AIF, be it category 1, category 2, or category 3, starting from the pre-investment stage to helping manage the investments on an ongoing basis, a very elaborate portfolio analytics suite to give the fund manager complete control over the portfolio, and strong compliance and monitoring rules that are completely configurable that can be set up in the system. And our channel system will manage the entire marketing and distribution, be it onboarding distributors or onboarding investors, managing the life cycle of the investors, initiating corporate actions such as drawdowns, distributions, all of that. And the system will be completely integrated with all the other ecosystem players that an AIF would have, right? So yeah, I think we're almost close to the end of time. So these are just broad areas where we help AIF. So we have a fund manager cockpit, a distributor onboarding suite, a portfolio rebalancing system, risk management system, a transaction management system, and a compliance management system. So all of these are modules that we have. And just to end this, so why choose FinIQ? I think FinIQ has a complete portfolio analytics suite as opposed to traditional platforms. So the fund manager can test the portfolio out. Trade capture, confirmation, reconciliation, and integration with banks and all other parties, again, can be done by FinIQ. We have a global capability, so we are present in more than 15 countries across Asia and Europe. So we are very, very strong when it comes to following the laws of the land and configuring our system to align with those. And from a technology perspective, FinIQ has an interesting low-code, no-code toolkit, which gives us a great advantage to configure new rules, products in our system with a very low turnaround time. So I'll just leave our contact details up here on the screen. Anybody who is interested to connect with us, please feel free to take them down and reach out to us. We'll be happy to connect and take this discussion forward.
Yes.
Thank you so much, Alok and Soham, for the time and effort, and more importantly, sticking to the short window we had here.
Yes,
audience, please do reach out to FinIQ team if you want to know more. They're based out of BKC, Mumbai. If you're working in and out of Mumbai, then you can always give them a shout and catch up with them. So quickly moving on. Thank you, Alok and Soham, for joining in. Looking forward to more. And I'll quickly move on to the last session of the day, which also happens to be a very, very interesting masterclass we put together for you all. And we have with us here Mr. Sushant Pote. He's the principal real estate at Axis Asset Management. Sushant, may I please request you to put on your video? Yeah, Sushant, hi, you there?
Hi.
Hey, hi. So sorry for the delay. I mean, the sessions have been running a bit late. But quickly jumping into your session. So audience, please join me in welcoming Sushant Pote from Axis Asset Management for this very, very interesting masterclass on financialization of real estate. Sushant joined Axis AMC in 2018 as principal real estate. His area of expertise include deal sourcing, project evaluation, and asset management. And he has hands-on experience investing in markets like Noida, Ghaziabad, Pune, and Tirupur. His experience spans across strategies, structures, and regulations, both at offshore and onshore level. Prior to this, he was associated with Portman Holdings, which is a US-based real estate developer and investor, as vice president. He started his career with Landmark Holdings, a real estate private equity firm, as senior associate. Prior to this, he studied production engineering from Government College of Pune and has done his MBA from IIM Lucknow. So Sushant, thank you for joining in and for patiently waiting for other speakers to get done with. So over to you. And this is the last session of the day, so there's no really time constraint, but not wanting to keep audience away from their dinner, we'll try to keep it around 45 to 50 minutes. If we have time at the end, we can take some Q&A. I'll be happy to moderate that.
Sure. Thank you. So thanks everyone, and thanks for this opportunity. I'll just share my screen. And is this visible? Is this visible? And I hope I'm audible.
Yeah, it's visible, and you're also audible.
Okay, great. So, what I know this is the last session, and I'm sure you have already gone through quite a heavy dose on this on alternatives and PMS. So I'll try to keep it brief. In this session, what I'm trying to focus predominantly is on the real estate, and particularly financialization of the real estate. So real estate, as we all know, it's one of the very old traditional asset class. And what we call it's the ultimate consumer durables with very, very high utilitarian value. We traditionally, if you ask our parents, grandparents, or their forefathers, the traditional investments were always in either real estate and gold. And it has, over a period of time, it has proven its worth. People have seen how the asset values have increased and how they could make good investment in this asset class. So coming to the basics of this asset class and looking at the value chain of real estate, typically we divide that into three buckets. One is the land, second is the development, and third is what we call is built out. So the first stage, which is land. So real estate is essentially land, right? Any real estate you take, underlying or the literally beneath, physically beneath any real estate asset, there will always be land. And land we typically divide into three parts: agricultural, non-agricultural, and infrastructure. And I think the names are self-explanatory, but just to give you a context, whenever a town or city is developed, the first stage of that is that the land gets converted for its non-agricultural use. It's converted for development. That's when the first leg or the first stage of value addition in value addition happens. The second is what we call is infrastructure. When a certain part of land or certain area is integrated into the master plan of a city, and it gets connected with the main hubs, whether the infrastructure like the roads, power, sewage system, etc., put into place. That's the next level of value addition which happens in the land. So this is the first leg or the first stage of land where the journey of real estate starts and where stage by stage the value addition happens. Next is what we call is development. So let's now let's go to the next phase. So within the development plan of the city, within the boundaries of the city, now a developer or a builder or an individual, he takes a piece of land and envisages a development there. So the first, where broadly, let's say somebody has acquired a land and envisaged development, but where there is broadly just a master plan. That's the first stage within the development, was what we call is non-approved, where predominantly the broader concept, broader layout of the development is envisaged. The next is when you have gone through the process of seeking appropriate approvals for doing the development or constructing a building, whether it's residential, commercial, retail, etc., etc. When it is approved, that's the next stage of value addition. And finally, when you start the construction or when the development happens. So this is the second bucket, what we call is development. And the third is what we call is built out, where the first stage is what we call as OC, second is CC or completion. And in many places, these terms are used interchangeably. So essentially, it's the completion of a particular project. That's the next critical and important milestone. And after that, the final is what we call is infill, when the completed building or the completed project and the surrounding on it, they become part of a integrated area. So let's take example of Powai in Mumbai. So originally in the let's go back only till about 1980s, when that was a barren land. It was part of, let's say, city's master plan. So we will start with, let's say, inland stage 2 or stage 3. That's when the infrastructure, the road around it, etc., was there. Then the development stage. So from almost say 2090 till early 2000, this is the development stage where this particular developer, Hiranandan, it has conceptualized the master plan. Then slowly each and every building, whether it's the residential, commercial, retail, he kept on building and constructing. That's where the approvals, the construction happened. Then if we look at particularly post 2000, or particularly let's say post 2003 or 4, that's when the township was complete. But after that, it really started becoming what we call is this infill stage, when a lot of offices started moving there. Those got occupied, a lot of retail started moving there. And today this area is one of the, let's say, prime portions or prime part of the city. So that's the last stage of the value addition, what we call is a built out, which has happened. Real estate adds the appreciating nature of real estate. It has attracted investors and people over centuries, over a period of time, and it has proven its worth as a trusted asset class. However it may be appealing, it comes with its own set of challenges. And that's where this financialization or investing into this asset class through a different mechanism. So traditionally, all of us, including our forefathers, we had been investing in the real estate in the form of physical asset, whether it's your home, your office, your shop. We buy a particular asset and hold it, use it, and for a period of time, its value increases. That's something we have been doing. But today, with the financialization of real estate, you have financialized instruments available. One can invest in this through alternatives. And we'll try to explain why fundamentally it is better and why it is different from investing in direct physical asset. So very simply speaking, there are three broader challenges. One is it's a complex asset class. There is whether you want to invest in residential, commercial, retail, hotel, warehouse, data center. First, one needs to understand that. Second, once you have got some clarity on that, secondly, which city, which part of the city you want to invest. Thirdly, what mix between these asset classes you want to have. Fourthly, how do you invest, whether you want to invest directly or use some instrument, which developer you want to invest. These are the various challenges which are there. Second, it's illiquid. Let's say somehow you have figured out the answer to the first question. Investing in easy, getting in easy, but getting out is very, very challenging. It's an illiquid asset class. at what stage one has to exit, when the exit will happen, how the exit will happen, what is the assurance, what is the surety, in what is the strategy for exit. These are the key challenges in this stage. And finally, real estate always requires higher ticket size. But through alternatives, these challenges could be overcome. So although it's a complex asset class, there is a professional team which is managing it. And since it's done from a skilled team, there is a scientific method to address which asset class to take exposure at what stage one wants to take exposure, through what instrument you should take, which developer. These are very, very well professionally managed. Second, although the asset class by itself is illiquid, but when the investment happens in a institutionalized alternatives way, some of these exits are inbuilt. Also, the exposure taken is such that you get at a particular stage. The way the investment is structured, it's envisaged, it's monitored. There is a natural path, natural progression which happens to these assets, and that's how the exits are realized. Additionally, there are contingency plans which the professionally managed funds keep in mind, and they incorporate into these investments. And lastly, even though for these investments are of high ticket size, since it's a pooled vehicle, it's a pooled fund, for individual investor, the amount which he needs to invest, that comes down substantially low. Very simply, what we are trying to say is what are the advantages, what is the difference between investing directly in physical real estate versus investing through fund. First is, by investing in real estate, you are achieving asset diversification. That's possible physically as well as whether you invest in fund. Second, the geographic diversification. Only a fund can give you exposure to different cities, or within a city to different micro markets. Individually or taking exposure in physical real estate, that's not possible. Developer diversification, like a fund, typically when a fund invests, we invest in, let's say, about 6 to 10 or 12 projects, and that with the developer diversification, also geographic diversification achieved, which is not possible when you do a direct investment. When the power of negotiation, when fund invests with anyone, that's a significant amount of money, and when the amounts are large, the negotiations, the rights, the control mechanism, these are put into place versus an individual trying to invest whatever may be the amount individually with a developer. Some of the investment avenues might be available, but the rights and the negotiating or bargaining power is not available. Then the fund does its own due diligence. There is a significant asset management or monitoring which happens with this project. The payments are secured by creating various collaterals, security mechanisms, etc. And since the amount which is managed is at a larger scale, the managing cost or the overhead cost, as we call, that comes down significantly. And the only perhaps drawback is the investor doesn't have the discretion to make the investment choice. That right is with the fund manager. Simply put, these are the various segments or asset classes in real estate where one can invest, whether it's residential, commercial, retail, hospitality, industrial, or warehousing, etc. Simply put, if we look at risk return parameter, the product, what I try to depict here is simple 3 types of products. For the first is what we call is the core. These are the completed rent generating assets. So REIT is the great example of that, where, one is taking exposure to a completed asset. So practically the risks are very low. That's the only risk you run is the vacancies or the lease rentals, what one generates. So the core or rent generating asset is what we call is low risk, low return. The next stage is what we call is the development. So if I refer back to my first slide where we have said we divide real estate into 3 buckets. One is land development, and third is what we call is infill. So infill or completed asset, that's what the REITs correlate to. In the development stage, there are risks, but these are medium risks. Similarly, the returns are medium. So here, what the stage at one we invest is at the development stage, where the land is already in place, some of the approvals are already in place, and essentially you are waiting for the development to get completed and then the exit to happen. And at this stage, one can take exposure within the form of debt or equity. For example, at Axis, we have a fund which focuses on the development stage of residential real estate, and that's in the form of debt. So this is a real estate debt at the development stage. This is what we call is at the medium risk and medium return stage. And finally, real estate equity. This is again at the development stage. So one may not come. So one may take exposure still in the development stage. However, the nature of investment is in the form of equity. So the returns are not capped, and potentially one can make better returns. But similarly, the risks associated with that also are relatively higher. So Axis, also like that, Axis AIF, we have a fund which focuses on commercial real estate, and here the underlying nature of investment is equity. So there the return and risk profile is relatively higher as compared to the other two. So what we are trying to say, simply put, the higher we go up in the value chain, the returns are going to be less volatile, because in AIFs in general, what happens, or alternatives, what happens is here many of these funds, and I'll just go back to the previous one. I think just the last point here, when through alternatives, when we invest in real estate, the idea is not to make so much return from the price appreciation, because in real estate, if I ask you what is the underlying strategy, what is the underlying nature of the investment, typically the idea is you buy low and sell higher, like we see in trading. Like that, one expects that I will buy whether it's a home or office, and within that also one would think that I'll buy at the early stage when the development had just started. So when it finishes, I will get premium. One is because the nature or the risks associated are low. Also, the price will appreciate, and the price had been appreciating over a period of time. But that's the strategy, or that's the game when one takes exposure or one takes punt in form of physical real estate. That's the strategy. But in alternatives, most of the time, it's not just the price appreciation which is the basis of the investment. For example, the real estate debt, the underlying principle is that you look at the margins. So even with the same prices which are there, for example, if the debt is being given to a residential real estate project, the way the underlying happens, or the way the investment strategy is, it assumes that the prices will remain stable, stagnant for the next 5 years. And that's which is, let's say, a typical life cycle of a project. If with that assumption, if there is enough margin, if there is enough surplus, if there is enough juice in that project, then only that investment happens. Similarly, when the investment is done in the form of equity, the underlying assumption in most of these cases is that you don't assume that the price are going to escalate at an astronomical rate, or even at a normal inflation adjusted rate, and with that you will, basis inflation only, you will make return. That's never the case. When alternatives invest in real estate, essentially you are taking exposure, you are investing in the business rather than on a particular asset, and you're trying to get returns from the appreciation in the value. So if we look at these 4 avenues, so what we are saying is one can invest in real estate as a physical asset. That's the basic strategy. Secondly, let's say if one wants to do financialization, well, even real estate stock, that's a financialized instrument. You can invest, but again, you will take exposure to a particular company, and taking exposure to, let's say, few companies, you can still achieve diversification, but still that's a limited or concentrated way. The next is REITs, which is a fund, a pooled vehicle where you will get diversification, but again, the at the base, the core strategy remains the same. It's low risk, low return kind of game. And finally, the real estate AIF. Here, each fund will have its strategy, whether, as I said, whether it's residential debt or commercial equity, and there all the features of a typical fund, the diversification in terms of geography, developer, having the professional fund management, all these are in place. So the AIF or alternatives, or in this case, as we go higher, the returns are expected to be less volatile. Again, this is a simple, I think, a repetition of what I said, so I'll just keep this. And now coming to the basics of financialization, what has catalyzed the process of financialization of real estate? As we all know, around 2017, 3 large changes happened, which have been there particularly for the real estate. These 3 things are demonetization, GST, and RERA. And this has completely transformed this sector. Till these things came into place, although real estate was slowly going in the direction of being organized, structured market, but these 3 things which came together in a short span of time, they have completely metamorphosed this industry. Because of demonetization, a lot of cash element which was there and which was limiting the play for institutional player, for institutional investor, for creating regularized investment vehicles. Those constraints got removed post demonetization because the cash element from this industry has been vanished. Secondly, GST ensured that throughout the value chain, the impact of or the effectiveness of doing business in a proper way, in an accounted way, it has come on the fore. And finally, RERA, which is a absolutely game changer in this sector. This has ushered an era of financialization. And very broadly speaking, this has got like 3 things into place. One is the governance. What RERA has done is, pre-RERA, this particularly on the residential real estate, this was completely dominated and one-sided play with developers, which has got changed. It had made the developers responsible. Today, before selling any residential, one has to first get all the approvals, register the project on the RERA. You have to give a definite timeline. You have to give all the specification, design, how it's going to be developed. And it is essential to complete the project within the timelines. Otherwise, there are heavy penalties, including imprisonment, which have made this industry or the players to be very disciplined. All the people who were fly-by-night operators, not so much wanting to follow the rules, who had buyers' well-being or buyers' interest, who had kept it absolutely at bay, all those had to weed out, all those have to go out from this industry. Secondly, there are substantial clauses for buyer protection. So the advance taken, I think one of the key problem with residential real estate was the diversion of funds which was got from, or the advances from buyers, which a developer gets for a particular project. And then it has various uses, predominantly going in buying the next land, etc. So RERA is ensuring that if somebody is collecting advances, it goes in the development of the project. Even the contracts today, they are absolutely fair-sided, which used to be absolutely one-sided earlier. There is a RERA affiliate who gives you a speedy justice, so on and so forth. And finally, market expansion. RERA has really made real estate a well-defined and pre-specified product with definitive timeline. And that facilitates the entry, and that facilitates the funding of organized players like us into this sector. AIF, these are some of the snapshots. I think all of us are in this industry. So I'll just skip this. Structure also we all know. And very briefly, what I'll do is I'll just spend about 5 minutes to give you overview of what's happening, particularly in the residential real estate and commercial real estate. So the last 2 years, the calendar year 2020 and 2021, like all other businesses, real estate also got impacted by COVID. However, the comeback or the bounce has been substantial. And few of the things which noticeably happened during COVID and post-COVID. One is that during the COVID, the importance of having in the traditional way, what we call is having a roof on the head or having your own home. It got underlined, it got underscored because people realized our home, that was our first line of defense against the COVID. So a lot of people who were fence sitter, who wanted to buy but had not made that decision, this time a lot of people took that decision, they bought it. So if from the graph as it clear the 2020, the both demand and supply, which is basically new launches, they got impacted. But from 21, it started slowly coming back. And the first half of 2022, the sales, they have been highest since calendar year 2013. This is the data by Knight Frank, and again, this comprises of data of first of the top 8 odd cities. Even the launches or sales, they are highest since almost 2013, and there's substantial improvements which we have seen. Secondly, in terms of prices, again, this is a data across the cities, and the range is between 3 to 9%. So on average, about the prices have gone up about 4 to 5%. One of the key things why this has happened, and I think we'll cover in the next slide. And before that, the inventory or the unsold units, as we call, this also is slowly coming down. So as on the first half of 2022, there's still about 440,000 units. These are in the top 8 cities of India, which are unsold. This is an interesting slide. This is again by search by Spark Real Estate. So we have used it as a placeholder, but it matches our thought process and how we look at the residential real estate. Typically, the cycle in residential real estate is about 8 to 10 years, where almost for about 6 to 7 years, we'll see stagnation or slowdown. And then there is then there is a rebound and things go up sharply within the next 2 to 3 years. So the last peak of this cycle was seen somewhere around 2014. From 2014 to almost 2020, there was a contraction and then there was a recession. And from 2020 onwards, the cycle is expected to turn around, and it has turned around, although it got delayed a little bit by the COVID. But that's where the current status or the current residential real estate cycle is. So in residential real estate, broadly, 2 things are happening. One is, as per the underlying nature or as per the underlying structure of this industry, we are currently in the expansion or growth phase. Secondly, for last almost 6 to 7 years, the prices have been stagnant. In some cases, the prices have even corrected. But on the other side, the income of the people has been raising. One can argue whether it was 6%, 8%, 10%, whatever CAGR one likes to take, one can take. But the income has been growing. So today, people are in far better position. What we call is the affordability, where the numerator, which is the price of the house, is almost same for last 7 years. But the denominator, which is the annual income, that has grown up. So the affordability is at a far better level. And that's what has resulting into the improved traction or improved sales. Naturally, the couple of concerns have been the increased input cost, which have resulted in a little bit price changes, which were exhibited. And secondly, the mortgage rates, which were almost decadal low till almost 3 months or 4 months back, those are slowly inching up. However, that dents the sentiment a little bit, but it's so far the impact has not been great, at least in terms of number of sales. This is the broad overview of commercial real estate, and here the parameters tracked are what is the net absorption plus new completion and the vacancy. And as you will see, this is from second quarter of 2020 till first quarter of 2022, when the COVID significantly impacted. How the grade A office stock in India has experienced the changes. Before that, to give you an idea, the grade A office stock in India is roughly about 700 million square feet. And just to give you a comparison, the Manhattan district in New York, just one part of that city, has about 500 million square feet of grade A stock. And as a country, India as a whole, we are at about 700. So that's the kind of gap which exists, and we believe there's significant room for growth and expansion of this sector. Secondly, on an annual basis, pre-COVID, the average annual absorption was about 40 million per square feet of grade A office, which roughly translates into 10 million per quarter. And if you see the light blue columns, it had gone down almost to about 3 million. The first quarter of 2022, it has bounced back to 11. The second quarter, the numbers are just getting out, but those will surpass this. So quarter 4 of 2021, quarter 1 of 2022, and even this quarter, it's bouncing back significantly. And Bangalore and the southern cities predominantly where predominantly the action is because of the IT, whether it's Bangalore, Chennai, Hyderabad, and even Pune up to a larger extent. These are doing significantly well. In terms of the nature of occupiers or the people who are leasing this, you will see till almost 2020, the half or more than half was predominantly IT/ITES. But after that, the pattern is evolving. Still, IT/ITES is naturally still one of the dominant players. But e-commerce and significantly the co-working, they have become a dominant player in terms of absorption. And then there are others like whether it's the BFSI, telecom and healthcare, they are also formed significant part in the absorption. Rentals, again, the southern markets plus Pune, they are growing at a steady pace. During the COVID, there is an impact, but I think it's important to note that the rentals, they are not gone down. They've been stable in some places. In some places, there was minor correction, but overall, the direction is it's growing. Also, the other point I wanted to highlight is even, and I'll go back to the previous slide, even in terms of absorption and the number you see here, this is what we call is the net absorption. So this will be net of cancellations, if any. So that number, although the rate of growth is reduced, but the absorption is still positive. So to give you an idea, in 2020 and 2021, the absorption of grade A office space in India was about 25 to 26 million square feet, which is 60% of the normal. But again, for the sake of repetition and mind you, it may be at 60%, but it was never a negative number. So unlike the popular thought or view that, with work from home, etc., this sector must be not doing so great and everybody must have given their office space. In reality, although the physical occupancy may have been low or for some time it was almost zero, but nobody has given up their spaces. Those were occupied and now it's growing up well. And the last point before I conclude my session is in commercial real estate today, we have 3 listed REITs, plus there is Ascendas REIT, which is listed in Singapore, but the underlying assets are India. And DLF has a subsidiary called as DLF Cybercity Developers Private Limited, which is again a listed entity. So there are 5 listed companies who own and operate about 120 million square feet of grade A office space. So that is roughly about 17% of the overall grade A office stock of India. And these listed players, they act as a barometer. So if you want to know what's happening in the commercial real estate, just look at these 5 listed companies. And I'm saying these 5 particularly because they are listed and you get the data on a quarterly basis. And it will, whether you want to see, look at the occupancy levels or the vacancy, which is a outcome of that, or what is the rentals, and even they give you collection, any parameter you want to track, you just look at that and that will give you idea of how commercial real estate is doing. So very briefly, in terms of vacancy, yes, the vacancy kind of increased during the COVID, but the impact is only to the tune of on an average about 5 or 6%, not like 30%, 50% or 60%. That's the extent of vacancy. Secondly, in terms of rentals, the rentals also have not gone down. In fact, they have been stable in some cases. They have improved. So that's all I have in my formal presentation. And I hope I try to limit within the time allotted. And I'll stop here and if time permits, we can take some questions, or happy to get back to any questions that you all may have.
Sure. Thank you so much, Sushant.
Thanks.
Actually sticking to the timeline. Audience, you have this on the footer, left side footer of your screen, you have the option to ask questions. So just click on that and you can, you'll find a tab for ask a question. You can use that if you have any questions for Sushant. I'll be happy to take, I think we can quickly take 3 or 4 questions. So please shoot quickly. Yeah, Sushant, I have one question here.
Yep.
What, according to you, are common mistakes which investors make when investing in real estate funds? How to avoid them?
Sure. So I think, in which is in any AIF, when you are trying to invest, I think the basic checks and the basic hygiene, what we look at. I think one is there are 2-3 things. Obviously, look at the background of the investment manager. If it is an institution, naturally it comes with its own set of checks and processes and balances and governance, which I think is very, very important, because this segment, these alternatives, it's still largely it depends on it's not as much regulated as, let's say, a mutual fund you will find. So an institution backed or have someone having strong processes, governance in place, that is important. Secondly, one has to look at the track record of the team, because a lot will naturally dependent on that. And finally, and obviously equally important, is the strategy and in what sector you are taking exposure, in what form and fashion, and what are the risks which involve in that strategy, and what is the plan to mitigate those. I think these are the important one. And in this, as we have seen the real estate AIFs broadly, they have been a mixed bag. But again, this overall investment industry, it has come up through its learning curve, and today it's broadly take all leading players, and I will not only say that we are the only one who are doing it in the prudent way, or as in there are others also who are doing it. So it's important to understand the strategy. And in this real estate, I think I'll just give one key thing which one needs to look at is, in real estate, the most important thing is completing the project, reaching the finish line. And so to see how one is trying to achieve that, and very importantly, how the financial closure of any project, what is the strategy for that? I think that's something people have to keep in mind. Naturally, if you're going in REIT, then those are completed assets. So there, that question doesn't arrive. But when you're going in the under development stage, I think what is the strategy for completion and how financial closure is ensured, those becomes important. And from our perspective Axis, we never come at the land stage. We are never trying to make money or gain. So going back to my first slide, there is a land stage, there is a development stage, and there is infill or completed assets. We predominantly focus on the development stage, where there are moderate returns and moderate risk. The early land, it has naturally more returns, but it comes with its own set of challenges. And the last one, which is completed, it has low risk, and similarly it's associated with low returns.
Yeah, one more question is there. One sec. Yeah. So what are your views on the new age real estate investment platforms? I mean, I'm assuming he's talking to this fractional investment platforms.
Sure.
Vis-a-vis REITs.
Sure. So these new age platforms, I think they come with the ease of investing at a click of button one can do. My main concern with them is these are completely unregulated one. So, one has to be very, very careful, because in financial investments, when it comes to investments, I think, again, to the previous question, I said the first thing one needs to look at, what are the guiding principle, what is the governance structure, how it is being managed, how it is regulated. That's the very, very important question there. And most of these fractional ownership, as in it sounds absolutely great, and in terms of I think whatever we also see, the return projection, etc., they are significantly different, so naturally one may get tempted, but I think the biggest concern there is this is absolutely unregulated investment instruments or vehicles.
One more question. What is Axis AMC's competitive advantage in the real estate fund space?
Sure. So I think one of the important things is if we look at the team profile, and I would encourage you all to visit the website and maybe see some of our pitch books or marketing collaterals. The way our particular team is structured, and within alternatives, I think firstly, Axis AMC has huge focus and there is a huge expansion strategy for alternatives. So that's a very serious business line for us. Within alternatives, we have a dedicated team for real estate. So there is a specialized team of 5 members who focuses and executes only and only real estate. And within that, the way we have structured this team, we are not just people who have financial expertise, but we have worked in this industry. We understand how the business works, what are the nuances, what are the key things one is to look at. And again, for the sake of repetition, I will say in real estate, the most important thing is reaching the finishing line, completing your project. If you have a completed project, most of these risks are mitigated. And just to give you a few examples, referring to my earlier point that we come with significant experience. Mr. Balaji Rao, who heads this vertical, he's veteran in the industry, about 3 decades. He himself has developed 10 million square feet of real estate. I come with a developer background as working with a US-based developer called as Portman Holdings, who have done significant investments and co-developments in India. My other colleagues, they also come with similar background or substantial exposure to real estate. So it's not just the financial expertise, but understanding the underlying nature of this asset class, that's important. And that's where I think is Axis's differentiation.
Okay, audience, if you have any questions, please quickly use the Ask a Question tab. We'll take another 1 or 2 max. Okay, I think this is an interesting question. We'll take it as the last one. With regulations permitting, I'm assuming the regulations are permitting a product like that. What kind of innovative product you can think of which is not available right now in real estate that you think is the potential of being a market winner?
Sure. So this is going to sound a little bit marketing for our own product, but one of the things that we are doing, and which is interesting and unique, is we have launched a commercial real estate fund, and it is focusing at the development stage. Today, like referring to the previous question, today there are quite a few investment options to take exposure to commercial real estate, but all these options, or most of these, they are into completed rent generating assets. like as you can logically think, right? As when we have seen the value chain, land is the first stage, then there is a development, then there is a completed asset. And if you come at the earlier you come, naturally the returns or the margins at that stage are more. So the most of the REITs or fractional ownership, they are operating in the completed or the last leg. While what we are doing is we have offered a fund, or we are coming up with a fund which is at the development stage. And there importantly, we have tied up with one of the leading world-class developer. It's called Tishman Speyer. So for the HNIs or the retail investors or the ultra HNIs, this is the only fund which is offering an opportunity to participate at the development stage. So, and going back to my simple chart, naturally it comes with its set of concerns or challenges, but with a partner like Tishman and with an institution like Axis, we have figured out a strategy. How do we want to mitigate and earn moderate returns against the moderate risk which are at this stage? So at the development stage, there is no one offering any fund to partake in the margins or returns which are there in commercial real estate.
Super. I think so, guys. I think we will have to wind up. We're out of time now, and I'm sure audience also waiting to get back to their family lives. So thank you, Sushant, for joining in so late.
Thank you so much
patiently
for
taking the
time
questions
and opportunity. Thank you so much.
No, always pleasure to have you. Audience, thank you so much for being with us today. I hope you found the sessions interesting and beneficial. So we look forward to see you all tomorrow for the offshore investments segment. Till then, good night. Take care.